Right now, I would describe the data as somewhat concerning, but not overly concerning.
At face value, this is certainly not good news for the Fed. And the bond market and the equity market is reacting accordingly.
They shouldn't overreact to this, but at the same time, they say there's nothing here which says that inflation is cooling.
The prospect for further rate cuts has diminished considerably.
Markets love certainty. They love predictability. We don't have that at the minute.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Thursday with your scores looking like this. Equity futures on the S&P 500 totally unchanged, on the Nasdaq positive by 0.1%. After inflation came in hotter than expected yesterday, this morning you get another read on inflation. PPI 8:30 Eastern Time, together with jobless claims. Fed Chair Jay Powell says we want to keep policy restrictive for now. Economists are asking, what would it take to hike?
At a point when you saw the fastest CPI growth for the past 3 months going back to November of 2022. Here's the issue. Jay Powell got comfort from the fact that one or bad, two readings, we can look past it. The problem is when you take a look at the average, the 3-month running average of this CPI, it comes in at an annualized pace of 4.5%, which is the most going back to 2022. It's a little more than for a lot of people in the market.
It pushed yields higher across the curve. The 10-year at 460, slap bang in the middle of the range for 2025. The low around 440, the high around 480. This is the most fascinating market we've seen since the pandemic. Yields were up off the back of CPI, but the dollar was weaker and crude was lower. The why? This headline right here that crossed the Bloomberg terminal at midday yesterday at noon. President Trump talks with President Putin.
So they had a call, and I think yesterday the prelude to all of this, really the olive branch and opening up and a thawing potentially of this relationship was, of course, the prisoner exchange and Mark Fogel coming back to the United States. Trump said he had a lengthy call with him. This wasn't just about what's going on in Ukraine. They discussed energy, the Middle East, artificial intelligence, the power of the dollar, according to the president. And now he said talks will begin on ending this war. And he talked about individuals that are going to be involved in that. Steve Witkoff, Secretary Rubio, other individuals, part of his team. And he said potentially not just that Putin would come to the United States and he would go to Russia, but their first meeting would be in the Gulf in the kingdom.
I'm not sure if the European leaders feel this way, but good news for the Europeans if you're looking at the euro. Stronger if you're looking at energy, crude, lower across the board.
This was the potential tail risk for the euro region. This was the unknown question about how much this could single-handedly bolster the entire outlook for the European project. Here's the question, and here is the rub, and it is a big rub. Bloomberg Economics expects that this plan could potentially cost European governments some $3 trillion to expand their NATO presence at a time where they would have to do it in debt markets with still elevated inflation. A huge question mark about how they would do this, whether they'd be willing to do this, and whether they're really on board with the way these negotiations are going down.
Well, there's going to be a lot of criticism towards this administration, especially when you have the Defense Secretary Pete Hegseth being in Europe saying that NATO will not be a part of this. That is a 180 from what we saw from the Biden administration. But I think a lot of individuals that are looking at this administration are saying it's a compromise. Not everyone's going to end up happy at the end of it. And Trump is just being realistic about what can get done to end this war.
3 days of euro strength. We're back at 104. Euro dollar 104.20. Positive on the session by a third of 1%. Coming up this hour, we'll catch up with Julian, Emanuel of Evercore on equity market volatility. We'll speak to Nadia Wiggen of Svelland Capital as Trump and Putin agree to Ukraine talks. And Steve Ricchiuto of Mizuho, who says the rate cutting cycle is over. We begin this hour with stocks steady as traders await fresh US data following yesterday's hot inflation print. Julian, Emanuel of Evercore writing yesterday's CPI reinforced the 3 steps forward, 2 steps back, volatile market environment that will be a part of the road to S&P 500 6,800 at year-end 2025. Julian joins us now for more. Julian, good morning.
Good morning.
You wrote yesterday, it's not the 1970s show. What is it?
It's 2025. And in reality, if you think about it, every asset market has been in this incredibly volatile but range-bound condition since the election, right? And so we're trying to sort through the potential for stronger growth, the potential for geopolitical shift, versus the potential for some of the policies that are being considered to be increased inflation and drags on growth. And basically, the net out of it is we're in this waiting game for further development.
Can we talk about the potential for rate hikes? How high is that bar?
extremely high. I think there are a lot of reasons. Look, first of all, expectations are still well anchored. Okay, there's a lot of volatility around the Michigan survey. The New York Fed survey is much more stable. And the reality is that when Chairman Powell thinks about his legacy, which, he's likely to be in a different position, let's say next year, it is wrapped up in delivering the soft landing. And a rate hike would be the thing that disturbs the potential for a soft landing. And again, history will say, if in fact inflation proves to be sticky into 2026, and we don't believe that's the case. We think this is much more like last spring, where you had several months of sticky inflation and then the path of travel continued lower. Once again, is that, the policies of the current White House would be the cause of the inflation if it were to remain sticky.
Which is the reason why you wrote there is literally no plausible scenario where the Fed hikes in 2025. I love that kind of conviction at a time where everyone else seems convictionless. Can you put into some sort of framework how much conviction you have in the 3 steps forward, 2 steps back that gives you the conviction to buy on some of the 2 steps back, because you have confidence that 3 steps forward are going to come?
Well, actually, if you think about it, and first of all, look at the sentiment surveys. There's a lot of bears out there. Markets don't top when there's a lot of bears, okay? And people can say all they want about the positioning. There is still cash there. We've seen inflows. And frankly, the way this market trades, and yesterday is a perfect example, it looked like the sky was falling at 8:35. And then basically people started reassessing. And from our point of view, what was interesting is that yesterday, the things that stabilized the market were the things that actually should have been the worst performers: technology, long duration, high multiple assets, which should have been, reacting badly against yields going up.
Yeah.
And they're secular earnings growers.
I want to pick up on what you said, which is sentiment is so bearish. A lot of people disagree with you. A lot of people say actually positioning is pretty bullish. Scott Rubner over at Goldman Sachs came out with this report where he said everyone is in the pool, including retail traders, 401k inflows, start of the year allocations, and corporates. You hear everybody who comes on the show, yeah, it's going to be volatile, but at the end of the day, buy, buy, buy. What makes you think that there's actually any bearish sentiment out there whatsoever?
Again, the moment-to-moment reactions, right? People are very quick to sell. The market bounces back because of all these reasons. And the biggest reason, which we haven't talked about, is that earnings are going to grow by 10% this year. And when you have a condition where earnings are going to grow that kind of to that kind of degree, and a Fed that, look, our base case is they still cut twice. They may not cut at all, but they're not hiking. That's okay. All of that lends itself to the idea that the bull market is not over.
You think they're going to cut twice? I have to ask about potentially this being the part of the 1970s that is reminiscent of a Fed chair that maybe is getting under a little bit of political pressure.
Look, then there's no question. And I think Chair Powell was wondering whether we were replaying back to 2018 in some respects. And that's a lot of the market action, 2018. But from our perspective, the fact is, if you think about those numbers yesterday and you think about the Fed as, a two-sided risk factor, in terms of uncertainty, well, we know one thing is certain. The Fed is likely not to be relevant until June. Okay, they're just going to wait and they're going to ingest more data. And that takes one thing off the table. But again, from our point of view, we just don't think you're going to have what we've termed an uncooperative Fed, which would be a hike.
The Fed doesn't want to hike. I think we're all on the same page. We can all feel that in the communication we get from Fed officials. Bank of America indicating that if you don't want to hike, don't cut. Where are the cuts coming from for you and the team? What delivers them?
It's again, this idea that the stickiness of inflation that we have right now is not permanent. The same way we saw it, again, continuous travel lower after several months of stickiness last year.
And how much more complicated does that picture get, though, when you have tariffs coming down the pipeline, potentially today, reciprocal tariffs line by line?
it gets a lot more complicated. And the offset to that is, I wonder if there's a bit of coincidence that the meeting between Putin and Trump that's likely to happen is happening in Saudi Arabia. Ground central for setting the price of oil. And when you think about why Donald Trump was elected, is because the U.S. population has been incredibly frustrated and stressed by inflation. And he said it himself prior to the election, is that, the easiest lever to pull is not the price of bacon and eggs or coffee. It is oil. And so that's the calculus.
The three biggest energy producers on the planet in the same place having talks, coming very soon.
Potentially very soon. And the president just said it out there. I have been talking to a lot of people. There's been preliminary discussions about this meeting potentially in Saudi Arabia, but the president just sort of put it out there for the world. Also, next week, he is going to Saudi Arabia's Sovereign Wealth Fund's conference being handled in Miami. So there's a lot of overtures and olive branches between Riyadh and the United States, and potentially Riyadh could be that place between Washington and Moscow.
Brent crude right now, negative 1%, 74.33. Julian will be sticking with us for an update on stories elsewhere this morning. For the latest Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Starting with the details of that potential peace deal, President Donald Trump and Russian President Vladimir Putin have agreed to begin negotiations for an end to the war in Ukraine. Trump added that he had had a conversation with Ukraine's President Zelensky and that Trump is open to meeting with Putin in Saudi Arabia. Before that, Defense Secretary Pete Hegseth said that Ukraine's membership in NATO is unrealistic and Ukraine would likely have to accept the loss of territory. Elsewhere, Japanese auto giants Honda and Nissan have officially called off talks to merge. French automaker Renault, which owns 36% of Nissan, said the terms of the deal were unacceptable. Private equity firm KKR is said to be considering investing in Nissan to improve its financial position. Now, fans of hit shows like Severance and Ted Lasso, good news for you. If you don't have an iPhone, you no longer need it to watch it on the go. Apple has made its TV Plus app available on the Google Play Store for the first time. Now, Apple rarely offers its services on its biggest competitors. It's a sign that it wants to broaden its subscriber base. And that's your brief, John.
Danny, thank you. Or it's a sign they're worried about things to come. So they might be forced to do exactly this, right? Which one is it?
We've seen that from China. We've seen that from Europe. We've seen that on the margins from the U.S. So lean into the content maybe before you're forced to not have that lever.
Without a doubt. More from Danny in about 30 minutes. Up next on the program, negotiating with Putin.
I'll be dealing with President Putin largely on the phone, and we ultimately expect to meet. In fact, we expect that he'll come here and I'll go there. We want to end that war. That war is a disaster.
Team coverage up next with Bloomberg's Tyler Kendall and Oliver Crook from New York City this morning. Good morning. President Trump this time yesterday morning, interest rates should be lowered. Inflation did not help. We get another read on inflation later this morning. PPI data a few hours away. Equity futures on the S&P 500 totally unchanged and totally unfazed in many ways at the index level by yesterday's data and the run-up in bond yields as well. Yields retrace some of that move. We're down 2 basis points on a session. It's a break of 460, just 459.94. Under surveillance this morning, negotiating with Putin.
I'll be dealing with President Putin largely on the phone, and we ultimately expect to meet. In fact, we expect that he'll come here and I'll go there, and we're going to meet also probably in Saudi Arabia the first time. We'll meet in Saudi Arabia, see if we can get something done. But we want to end that war. That war is a disaster.
So here's the latest this morning. President Trump and Russian President Vladimir Putin agreeing to negotiate an end to the war in Ukraine. The comments coming after Defense Secretary Pete Hegseth told NATO allies Ukraine would likely need to accept the loss of some territory. Our team coverage starts right now with Bloomberg's Tyler Kendall in Washington and Oliver Crook in Munich. Ollie, I want to come to you first at the Munich Security Conference that's set to kick off in the next couple of days. How are the Europeans responding to this, the developments of the last 24 hours?
Yeah, listen, Jonathan, I think they're still scrambling to figure out how to respond to it. I mean, listen, there's still a lot of sort of shock and awe from the Europeans. At least that's what they expressed. But I don't understand really totally why they're so surprised. It's fairly clear what the Trump administration was going to do for a long period of time. But what is becoming more and more explicit is that Donald Trump by himself is setting the table here. He's choosing who he's going to invite. And at the end of the day, he's going to want to send the bill to the Europeans. So for the Europeans who are meeting now with the Trump administration, J.D. Vance, Marco Rubio, Keith Kellogg, all of whom will be here over the next few days. For those Europeans who are hoping to have a conversation, to maybe have some input on what this plan looks like, I think that they are sort of dialing back that expectation and realizing that this is not the world of the former United States. Again, this should not become as a complete shock, but they need to figure out what their points of leverage, if any. Otherwise, this is just going to be dictated to them by the President of the United States, the plan for Ukraine. They keep saying no plan for Ukraine without Ukraine at the table. Increasingly, it's the Europeans that are not at the table, and they may just have to eat it at this point. This is the real concern for the leaders here, and that's who we're going to talk to over the next few days, whether it's the foreign ministers and the other sort of participants in this conference.
It's definitely not surprising given the rhetoric we saw from Donald Trump on the campaign trail. But Tyler, walk us through exactly what Trump outlined yesterday when it comes to ending this conflict.
Well, Annmarie, as you know, this is considered to be a reversal in U.S. policy under the prior administration that opted against this direct contact between U.S. and Russia, instead opting for Ukraine to take the lead. Now, President Trump said that his conversation with Putin was lengthy and productive and that these negotiations would start immediately. He also outlined that team that you heard Oliver say there, including Secretary of State Marco Rubio. And it came hours after these comments by Pete Hegseth that's also creating some concerns here about if this could give away any negotiating power. President Trump in the Oval Office during his remarks yesterday dismissed those concerns, saying that ultimately this is what needs to happen, needs to be brought to the table in order to make progress. Now, Annmarie, of course, you were the one that broke the story that Scott Bessent traveled to Ukraine in order to present this economic cooperation agreement that we're getting more details about which could ultimately result in more critical minerals coming into the U.S. That could be something that is critically important to securing additional U.S. assistance for the country, something that President Trump has pledged. But as you know, this is an issue that has long divided the Republican conference and could need some extra support, because when you think about it, one of the staunchest opponents to additional aid to Ukraine when he was in Congress was, of course, Vice President J.D. Vance.
There's also a question, Ollie, in addition to what Tyler was talking about with the economic plan, how it would affect the U.S. and Ukraine, who it leaves out, maybe Europe. But going forward, what it means in terms of the potential to join NATO, the potential to join the whole region's economic system. Ollie, do you get the sense that European leaders are on board with some of what we've heard out of U.S. administration leaders?
Well, listen, this is what they need to sort of reevaluate and come to a sort of collective view upon. I mean, I think that there are so many questions here. I mean, let's just deal with a couple of them. The military build-out, as you were mentioning earlier, we have this piece out today that says that's going to cost about $3 trillion if the Europeans want to get serious about their military build-out. At a moment where there is basically fiscal strain across all of Europe, everybody is combating within governments about where to spend money. You want to then up this sort of spending on the military to 5% of GDP. That is going to be a very challenging thing to do. There's also the other question about security guarantees. I mean, when Volodymyr Zelensky, the president of Ukraine, says, basically as he did this week, that security guarantees without the United States, i.e. just with Europe, basically don't mean anything, that is something that the Europeans need to reckon with. And if there is a grain of truth to that, they need to figure out how to sort that out. And the real question is going to be also peacekeeping troops in Ukraine. If there is, in point of fact, a ceasefire deal, what is the story going to be there? The United States says very emphatically they don't want any U.S. troops in there. They want to see European troops in there. I've spoken to senior lawmakers in the Bundestag of Germany, people who are very hawkish, who have been very supportive of Ukraine, and they say that that may be a shade too far to really put German troops in there to have sort of peacekeeping operations within Ukraine. So these are all the sort of issues that the Europeans are going to have to come to consensus to, and ideally do it pretty fast, because this is a situation in which Europe has been sort of waiting for the United States to act. Right now, it's just taking off and sprinting ahead, and the Europeans need to figure out to have a coalesced approach on how to deal with it.
Ollie, appreciate your time. Ollie Crook there alongside Tyler Kendall. The latest from the Bloomberg team. Let's park the politics and focus on the market pricing and the distribution of risks. Right now, the euro's stronger and crude's lower. Julian Emanuel of Evercore is still with us. Now, Julian, I'm not sure it's in anyone's baseline, or many people's baseline, that trade relations between Europe and Russia normalise anytime soon. But it's not zero, and the chances went up. As you reprice that story a bit in the last 24 hours, does that contribute to just lifting the cloud over European stocks and European assets?
Yeah, absolutely. And look, the market has gotten ahead of it. You've seen European shares outperformed to start the year. And the thought is, and again, there are puts and takes around all of this, but ultimately, if you had normalization and if you had a workable truce, it's got to be a positive for asset markets.
There was an argument at the beginning of the year, and we saw this come through, that the bar was so low for European assets to get some love that you might as well go there, especially given how high prices were in the U.S. Does that story still hold true?
Well, it does, but this is one of these sort of be careful how you approach it, because if you look at that line, the relative relationship between U.S. markets and European markets, it has been in a steady downtrend for a decade. And yes, there's been some stabilization here. But again, think about it is that if you had some sort of major catalyst that changes mood, and I would say, going back to the earlier catalyst, the abolishment of negative interest rate protocol was one of sort of the last times around. But to have that, it definitely lifts the cloud. And I think it's part of why, as much disarray as there is politically in Europe, you're seeing asset markets buoyant still.
There are so many potential unintended consequences of this policy. The $3 trillion of spending that the European Union might need to do in order to bolster its security apparatus is a big part of it. How much do you expect that to be financed through debt? And how does that change the picture for both the ECB and just the European debt market that a lot of people expected would be facing with stagflation and disinflation more than anything else?
Well, the first element is that it likely improves the growth trajectory across the continent. And will it be financed through debt? In all likelihood, that will be a large part of it. Will it cause the ECB to rethink its rate cut trajectory? Absolutely. But again, that's part of what's going on in all asset markets right now, because policy is sort of rolling out and, consequences and decision nodes are happening in real time.
If you're an investor, do you want to be exposed to Europe then at this moment?
Well, we think you dip your toe in. So basically, most global asset allocators have been underweight Europe, again, for the better part of a decade. And what happens very often is when the catalyst comes, the door to get in is far too small for everyone who wants to. So we think it's time to start, gently buying in Europe.
There's been so many problems with Germany and the German economy. Is this something that can open the door to a revitalization of German manufacturing?
That's a bit more complex because, again, as we know, Europe is very largely dependent on that mutual relationship, Germany in particular, with China. And China is a very large question mark in terms of demand from our point of view still.
Julian, it's always good to see you, sir. Appreciate it. So much going on. Julian Emanuel there of Evercore. It's been amazing to see the complaints come from the European leaders in the last 24 hours or so. I'm not sure they're in a great position to complain. They've made poor strategic decisions when it comes to foreign policy over much of the last 2 decades. They've underfunded defence for a long, long time. We've heard all the complaints about that too. And you've got an incoming president who's offering a solution. Now, maybe you're unhappy with the solution, but offer your solution. What's your plan? Because this war is not popular. And I sense a real distinction between how European leaders feel about things right now and how the people of Europe and Ukraine, for that matter, might feel as well.
Right. I was in Ukraine over the summer, and in the polls and even on the street, you could tell people were frustrated. They were upset. They wanted this war to end. What I find so fascinating about Europe is how are they shocked? I was writing 6 months ago how the Trump campaign, now administration, was going to force them to spend more on defense. If you want to be in the driver's seat of negotiations, then you have to be the ones with the pocketbook, the deep pockets to drive those negotiations and actually have a defense sector.
More on this story still to come. The euro is stronger off the back of this news for a third consecutive session. Euro dollar higher by a third of 1% this morning. We're up to about 104.22. Lots to talk about the energy market. In just a moment, we'll catch up with Nadia Wiggen of Svelland Capital as energy markets react to the prospect of peace in Ukraine. From New York City this morning, good morning. This is Bloomberg. Equities, no drama at all. At the index level, things have been okay in the last 24 hours. We erased those post-CPI losses. Equities this morning just about positive by close to 1/10%. On the Nasdaq 100, up by 0.2%. Where we did see some damage was in the bond market. Switch at the board and get to the bond market story. 2-year, 10-year, 30-year. 10-year yields higher by close to double digits in yesterday's session. So at 460, right bang in the middle of the range for the year so far. At the low end, 440, close to that level. At the high end, very close to 480. Here we are this morning, down about 2 basis points. I'm already thinking about March 19th, the next Federal Reserve meeting in the middle of next month, when they have to come out with new forecasts. Risks have got to be skewed to lower interest rate forecasts for the year ahead, to taking out some of those interest rate cuts for 2025. So rather higher interest rate forecasts for maybe the year ahead and after that. And I would also look at the long dollar as well, Bramo, the neutral rate, as Chairman Powell really started to question that too in his testimony this week.
There is a feeling that this is a Fed that's reassessing just how strong growth is and just how much inflationary pressure there is. One of the big questions that emerged from yesterday's hearing and some of the other Fed rhetoric, Chicago Fed President Atlanta Fed President Raphael Bostic, talking about 1 month of data, 2 months of data, they can kind of, dismiss that. We're getting 3 months of data that is significantly hotter. It represents something else that's more of a trend that they have to address in their forecast.
The hottest month-over-month print going all the way back to August 2023. That was the story stateside in the bond market. It was a very different story elsewhere. Check out the euro and check out crude. So after we got that headline that we had some talks between Putin and Trump, bang, euro stronger, crude a whole lot lower. The euro this morning stronger by 1/3%, 104.19. Brent crude down to 74.32. WTI here, Bramo, $70 and about 50 cents.
It was Kit Jukes, I believe, who said that he could see the euro dollar cross 115 even if you did get some sort of agreement between Ukraine and Russia. This has to do not only with cheaper oil prices for the euro region, it also has to do with the idea of just the supply chain of workers that came from Ukraine, as well as sentiment. If that happens, how much does that bolster the idea that Europe is actually the place to invest at a time when earlier this year everyone had left it for dead?
There's one pushback. We're already at all-time highs. Germany's already rallied by double digits so far year to date. Do we need more than just that? Do you need growth differentials to narrow?
Well, this is where it becomes incredibly complicated. One part of that bet was that the ECB would keep cutting rates. And Julian and Emanuel is saying, actually, if you end up with some sort of truce agreement that forces the Europeans to borrow some $3 trillion of debt, you might not get those ECB rate cuts. And that changes the whole investing paradigm. A lot of uncertainty and unintended consequences is the reason why people are somewhat paralyzed.
The euro stronger for a third consecutive session, 104.20. On our radar this morning, a judge clearing the way for the Trump administration's federal worker buyout plan to move forward, saying labor unions don't have legal standing to sue. About 3% of federal employees taking the offer, falling short of the White House goal of 5 to 10%.
And it falls short of their goals. This is 75,000 people. A 3% cut to the federal workforce would only bring the number down to 2023 levels. Why? The workforce grew more than 6% under the Biden administration. This was fueled by a lot of pandemic spending. There is a detail in this that I am going to be watching on Capitol Hill. The government currently is only funded until March. Basically raises these concerns of whether or not they can back these commitments to people that they will for certainly get paid till September, if right now the government only technically has the money to spend until March.
We've talked a lot about DOGE and the effort to cut costs. Increasingly, the conversation is going to be how much does this offset some of what they're planning on the spending side of things. And I will just say, after a somewhat soft 10-year auction yesterday, I'm looking just at the nuts and bolts from a market perspective, less on what gets through and more on what this means for the balance sheet. Does it actually move the needle?
The deficit, it grew by $129 billion in the month of January.
Thank you.
The deficit as a percentage of GDP, the Treasury Secretary would like it close to 3%. It was 6.5% in 2024. That's a problem.
Especially at a time where you have projections coming from the CFPB that potentially you could see a deficit of 7.5% in the next few years if this deal goes through as it is currently scheduled. So I understand this is emotional. It's going to be through the courts. In the meantime, there is a very real question about whether it even moves the needle when it comes to some of the cost savings required to get through some of the spending plans in place.
There's a very real problem that needs addressing, that's for sure. Speaking of things that are coming, this is coming apparently. President Donald Trump saying yesterday he would sign reciprocal tariffs as soon as this morning. The president set to sign executive orders today at 1 p.m. Eastern time ahead of his meeting with Indian Prime Minister Narendra Modi At the White House now, I wonder if Modi's India might be a target for some of these reciprocal tariffs.
Well, they could be on a trade-weighted basis. When you look at India's rate for U.S. imports, it's 12%. The U.S. rate for India imports is 2.2%. But Modi is coming prepared. There's a lot of reporting out there that he's coming up with additional tariff cuts ahead of this meeting. When it comes to reciprocal tariffs, my big question is, how are they actually going to do this? It's very difficult in one sweeping executive order to go line by line reciprocal tariffs for each individual country and potentially industries. Likely what this potentially will mean is a lot of work for USTR Ambassador Jamieson Greer once he's confirmed, and using the 301 that the administration used in Trump 1.0 when it came to China.
I just wonder how many days we're going to get where Donald Trump is looking for things to sign. I know I'm not saying that he's looking for things to sign, but it seems as though every single day.
Kind of sounded like you said he was looking for things to sign.
Well, I mean, plastic straws, come on. And we're talking about some of these things that feel like, pet peeves. It's sort of, you go into a restaurant, you don't get a plastic straw, you hate the paper straws, executive order. I mean, at what point are these real versus to sit there and sign a lot of things and be busy?
I think it refocuses the mind, particularly when it comes to places like California. Let's stop talking about straws and let's focus on making sure there's enough water when there's a wildfire.
Okay, I don't know.
Those kind of things.
That might be
I think
a little
that kind
bit
of thing
stretch.
matters.
I don't think that the conversation in the popular mindset went from plastic straws to California.
No, you become obsessed with the details. He's very frustrated about what's taken place on the West Coast. I think a lot of Californians are very upset with what's taken place on the West Coast.
I think that you're right. And I think when you spin it forward, there's a question of signaling and a sense of frustration versus actual policy. And I think that's my point, is that, yes, there are proclamations to set a tone. At what point can we view them as what actually is going to be in effect in 2-3 months' time?
Agreed. We're on the same page. Let's focus on the big issues.
Yes.
Let's focus on a big issue right now. President Donald Trump and Russian President Vladimir Putin agreeing to start negotiating on the end to the war in Ukraine. Trump saying on Truth Social the two had a, quote, lengthy and highly productive phone call just yesterday.
And obviously Ukraine was the star of this conversation, the focal point, but they discussed AI, the power of the dollar, a bunch of other things. Trump is saying that he has his team around him and they're ready to start these negotiations. Zelensky, interesting, was speaking to The Economist, posted an interview yesterday and was saying he hadn't had a ton of outreach from the Trump administration. But he did this week, actually, with Secretary of Treasury Scott Bessent going over to Kyiv. So Trump is trying to pull all levers when it comes to this. The big issue he's going to have is the Europeans. And Oliver Crook just walks us through some of the criticism we're already seeing from Europe, especially when it comes to the likes of NATO not being welcoming anymore, according to the United States, when it comes to Ukraine. The issue is the Europeans are the ones that want to be the driver's seat, but they're not being the ones that are willing to pay for everything that's been going on.
It's certainly pulling down crude. Brent's down by more than 1 percentage point. Similar move on WTI. WTI here stateside is down 1.2%, $70 and about 50 cents. Joining us now to discuss, Nadia Martin-Wiggen of Svelland Capital. Nadia, welcome to the programme. Let's talk about the developments of the past 24 hours. What does it change for this energy market?
Well, right now, it's brought to the forefront that discussions are underway and that the Munich meeting from the 14th to 16th of February, the pressure is on Europe to get its act together. What we see on the market side is that equity markets are already pricing in peace in Ukraine. But when we look at the commodities markets, they are not exhibiting that same type of pressure. And you can say that oil is a bit under pressure, but if we actually had the real semblance of peace, we would be trading in the low 70s, at least the bottom of the range that we've been experiencing. We'd have much lower natural gas prices. So far, the markets, in terms of the commodity traders, they don't believe it. Brent crude is still highly backwardated.
Do they not believe there'll be a peace agreement, or they not believe that Russian energy will flow as it once did?
Well, both sides. So the first part is whether there will be a peace agreement and how quickly. It's impossible for Europe to agree on how they will handle this peace agreement before the German elections. That's in 10 days. Then they can sit and work together and try to figure out what a peace agreement would look like, most importantly, in terms of enforcement. And this is part of what the Munich Security Council has to agree, because in their own notes and preparatory detail, they say they have to come up with an ironclad security guarantee that Donald Trump has said and Pete Hegseth have said does not include the U.S. on the front line. So they have to agree together. In terms of the energy side, that's what the German election is really considering as well. We have the political party, the AfD, that is much more pro-Putin than the other parties. They are willing to step away from NATO, and they would like to have that energy flowing again to make German industry more competitive. Then on the flip side, you have other parties that don't trust the Russians and believe we have to build Europe going forward. And the 5% GDP spending, that can really work on the industrial engine of Europe building these arms. But right now it's a very fragmented market. Germany creates things, Norway creates things. Norway's not even part of the EU. The UK is not part of the EU. So they really have to pull themselves together. And when we see Trump's tactics, he's being very tough on his allies and asking them to step up versus his actual adversaries. He's consistent. He's putting the pressure on Europe and going along, listening to what Putin wants. He's being very tough on Canada in terms of tariffs compared to how he's been on China, when we know his ultimate goal is to be tougher on China. And he doesn't like that relationship between Russia and Germany being so close together. He made that very clear in Trump 1.0 that he did not like this energy dependency. And Scott Bessent is in Ukraine now, showing that the U.S. is open for business. They will sell oil and gas to Europe, and they will take in exchange as a loan rare earth minerals from Ukraine. He's a transactional president, and it makes sense.
Nadia, one adversary, though, Trump has been tough on is the Iranians and the crude they ship to China. When you're looking at the oil market, how are you starting to factor in maximum pressure that we are going to see under this administration?
This is where we've really seen that playing out more on the shipping side, and Trump had a success in Trump 1.1 on being tough on the Iranians. And that's where the crude markets believe the most in the Iranian maximum pressure scenario. When we look at Russia, they are such a huge producer that Russian oil has always tended to get out somehow, even though it's in a tougher way. So on that side, we are looking at potentially a loss of 1 million barrels per day of production. But Trump also wants the Saudis to step in and produce more oil in that place. And the Saudis have this memory of Trump 1.0 when he granted a 6-month grace period for countries that were taking Iranian oil. And then the Saudis, the Russians, and the American companies brought back 2.5 million barrels per day of oil in anticipation of this outage of Iranian oil, and crude prices collapsed. So it's a much tougher negotiating tool this time to push the Saudis. Also, the Saudis have been very protective of the Russians up to now. So that relationship, very important. And it's not by accident that a meeting between Trump and Putin will probably start in Saudi Arabia.
Nadia, just real quick here. What are the chances, in your view, that we could get a normalization in relationship enough with European Union nations, with Russia, to allow Russian liquefied natural gas to flow once again through Ukraine into the European Union?
Well, right now, from a European perspective, what has been laid out in terms of peace sounds much more like a surrender for Ukraine. So there has to be an understanding that there will actually be a Ukraine and that it will be.
I think we've lost the connection there. That was Nadia Martin-Wiggen there at Svelland Capital. Nadia, we'll leave it there. Appreciate your time. I've heard a lot from the Europeans in the last 24 hours, and I think we should all respect their perspective on things. It's at their doorstep. And likewise, especially even more so, the perspective of the Ukrainians. But not in this enough has been the American perspective over the last day, I would say, and over the last couple of years. So let's get into that a little bit. We talked about the deficit here in America, 6.4% of GDP in 2024. The deficit in January alone pushing $130 billion US. Defense is $800 billion plus in this year per annum, every single year. There's a lot of money going to defense. And this is happening. I was just speaking to someone about this. This is happening as the Europeans have been underfunding defense for years. And even over the last 12 months have been buying record amounts of Russian LNG. Those numbers have been going up over the last few months. That's problematic. Now, when you sit here and look at all the numbers, OK, you want the Americans to provide you defense and continue contributing towards a war when they're running a massive budget deficit, and you're not following up and doing the same thing. You want the Americans to stay out of this and give you a seat at the table. At the same time, you're buying record amounts of Russian LNG and funding this war with the Ukrainians, and you want the Americans to fill the gap. Can you please make sense of that for me? And I imagine that Vice President J.D. Vance is going to go to Munich this week and probably push that case.
This is going to be a very different Munich security conference with the Trump officials than it was under the Biden officials. But Trump has been saying this for years. He has been hammering Germany. He hammered Angela Merkel on Nord Stream 2 when they wanted to open it up because of this fact. Why are we spending so much money on NATO, which is supposed to defend the European Union against Russia, when your entire economy is enslaved to cheap Russian fossil fuels? That has been his argument for years. And he's now coming to the table. He wants this war to end. And he's giving Putin an off-ramp. Now, one criticism I did hear out of Europe was that a lot of Republicans bash the Biden administration for showing their cards too much. And they're saying, is he showing their cards too much when it comes to not letting Ukraine join NATO?
The euro stronger this morning by a third of 1%, euro dollar 104.20. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Donald Trump and India's Prime Minister Narendra Modi are set to meet at the White House today. The two leaders are expected to discuss trade, including Trump's tariff threats. Modi made a series of moves in recent weeks to try to avoid those trade tensions. India slashed tariffs on items like luxury cars, while also agreeing to take undocumented migrants and boost purchases of U.S. energy. House Republicans have floated a plan to cut taxes by $4.5 trillion over the next 10 years and raise the debt limit. The plan does require at least $1.5 trillion in spending cuts in programs like Medicaid, Obamacare, and food stamps. Republicans' narrow and fractious majority, though, likely makes passing the bill difficult. And elsewhere, popular weight loss drug Ozempic appears to have uses that go beyond limiting appetite for food. A new study shows the medication reduced alcohol cravings in a small study of adults with alcohol use disorder. The findings may be a step forward in the treatment of alcoholism, which affects over 28 million U.S. adults. And that's your brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes. Up next, chasing 2%.
We're close but not there on inflation. We've made great progress toward 2%, but we're not quite there yet. So we want to keep policy restrictive for now.
That conversation up next with Steve Ricchiuto of Mizuho from New York City. This is Bloomberg. Good morning, Mr. President. Here's the post from Donald Trump this morning. First one out of the gate. 3 great weeks, perhaps the best ever. But today is the big one. Reciprocal tariffs. Make America great.
Okay, I'm sorry. You're not just signing things. This one is the great one. And we will see what this actually looks like. Of course, there are still questions about what this means, given that we've already seen quite a bit of on the tariff announcement.
Today's MAG, not MAGA, Make America Great. He missed, I guess, again. This is going to be interesting. Very difficult to have one EO for all these reciprocal tariffs. I wonder if this is just going to give more scope to the incoming USTR ambassador, Jamieson Greer, to go through line by line exactly what the president is trying to get. I was looking, though, at something he said on the campaign trail. He wants tariffs like for like, eye for eye, and potentially we're going to see that today.
Steve Ricchiuto of Mizuho joining us around the table. Steve, let's have that conversation now. Let's talk about the headlines we've just seen from the president. This is what we were expecting, reciprocal tariffs, and it comes at an interesting time. It comes at a time where we just had hotter than expected CPI. So let's start with CPI. What was concerning about that print for you?
Well, the continuous period, the extended period at which the core CPI numbers are running on the hotter side on a year-over-year basis. And everyone's always looking for a base effect to roll off, or everyone looks for an excuse for an individual component of the report to drive the report. The reality is this is an index for a reason, because it has to include lots of components. And when you look at a lot of the line item components, they can't even be seasonally adjusted. So we have to aggregate them in order to seasonally adjust it, because they are very, very volatile. And ignoring something because it's volatile is just an inappropriate way to deal with monetary policy. It's an inappropriate way to deal with economics, to be honest with you.
So step one, let's accept the data. You're accepting the data for what it is. Step two, let's incorporate something into the outlook. A change in policy, tariffs. What's the contribution of these tariffs going to be in the months to come?
Again, this is a difficult component because the dollar is firm and the global economy is particularly weak. You look at the response of China to the tariffs that Donald Trump has imposed, again, the additional 10% tariffs. It's a very, very muted response back. And I think it reflects the fact that there is a global excess supply of tradable goods. And as a result of COVID, we've diversified supply chains. We have more excess supply of tradable goods than we've ever had before. So there is offsetting pressures. So I don't think you can say, well, we bumped this component up, therefore we're going to bump this up in the inflation component. You have to look at the fact that margins are going to be squeezed.
When it comes to these tariffs, do you think they will be passed on to the consumer, at least a one-off hit?
It's possible. It's not definite. And it really depends on how tight the labor market is, whether the consumer matters or it bothers the consumer. Understand, what really took Joe Biden down, in my assessment, is not inflation. It was the level of prices. Moreover, it was the level of price and the fact that real disposable income was squeezed under the Biden administration. So if you're in an environment where prices are going up, but your income is going up and your purchasing power is actually expanded, do you mind? The answer is probably not. And that's the end game that I think this administration is going for.
Take it one step further. Bank of America came out and said the dollar may not like tariffs after all, even though the dollar's been on a tear because of these tariff threats. Because of full retaliation, the dollar could weaken. How vulnerable do you think the U.S. is to retaliation?
I think the global economy being as weak as it is reduces the ability of people to respond back. Again, we are the buyer of last resort. And so, therefore, there is a certain amount of power that is imposed or implied by that. And the administration is pushing that envelope. There's no doubt about that. How long can they push it? How far can they push it? They're going to attempt to find out. But you have to understand, the Federal Reserve is pushing the envelope as well. The chairman continuously talks about the fact that he believes monetary policy is restrictive. Yet he began cutting rates when the economy was running above trend. He began cutting rates when inflation was running well above the Fed's target. So was policy really restrictive? And now we're in a situation where policy is actually more accommodative.
Julian Emanuel was on the show about 50 minutes ago, and he had written, there is literally no plausible scenario where the Fed hikes in 2025. Do you agree?
There is a plausible scenario. There isn't necessarily a statistically viable scenario, okay? What I think you need to get the Fed to hike rates in 2025 is the unemployment rate to move significantly below 4. Put 3.8 at it, because once you get back to 3.8, you've basically taken all of the uptick in the unemployment rate that they responded to in cutting rates out of the equation. So therefore, they don't have that argument anymore. Then you take the 10-year note and say, if the 10-year note pushes above 5, then guess what? Their argument that inflation expectations are anchored goes away. Then you have a reason. So you have a necessary condition, the unemployment rate. You have a sufficient condition, the 10-year note. You're not going to get the 10-year note unless you get the unemployment rate. That's the key thing to watch. If the unemployment rate starts to move down and significantly below 4, the markets will jump the gun and price it in.
You know, when inflation expectations bottomed in the last 12 months, middle of September, what happened in the middle of September? Fed started cutting interest rates.
You know what Fed Chair Jay Powell said yesterday? He said that the reason why is not because of inflation expectations. He actually said that the increase in yields was due to other concerns, which I thought was very interesting, sort of discounting the argument that was implicit in what you just said.
What do you make of that? Is he giving a nod to politics? Were we thinking about that in the middle of September?
He's saying it's not my fault. Don't look at me.
Adam Posen of the Peterson Institute joins us in about 60 minutes. I think he might have a different view on things. Steve Ricchiuto from Zero. Steve, it's good to see you, sir. Cheers. As always, thank you. Coming up in the next hour, we'll catch up with Chuck Lieberman of Advisors Capital Management, Don Schneider of Piper Sandler, Andrea Guerzoni of EY, and Adam Posen of the Peterson Institute. What would it take for the Fed to raise rates? From New York City, the second hour of Bloomberg Surveillance, next.
Markets don't see too much permanence in the tariff impact yet, and that's where we fear it might be a bit of a miscalculation.
Tariffs don't lower inflation. Tariffs add to inflation.
The other thing that we don't know is to what extent the tariffs actually do get passed on to the U.S. consumer.
This is a new type of shock, especially on the tariff side. We have to be thinking about this tariff environment as a retaliatory one.
You always expect the unexpected with this administration, and ultimately I think we're going to head in the right direction.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
This is already shaping up to be a very interesting morning. Just not at the index level on the S&P 500, which is a total snooze. The S&P 500 going absolutely nowhere. Equity futures unchanged. On the Nasdaq at the moment, just about positive by 1/10%. Your day ahead looks like this. In 90 minutes' time, we get some economic data. PPI and jobless claims. At 1 p.m. Eastern Time, the president signing executive orders. That gets interesting because of this. From the President of the United States on Truth Social this morning, posting this one. 3 great weeks, perhaps the best ever, but today is the big one. Reciprocal tariffs.
So people are expecting some further announcement of exactly how there's going to be a tit for tat. We've talked about whether it's going to be line item by line item. We've talked about whether he has the personnel in place to actually go through with this. What I'm most curious about is the market's response to this. Right now, it's fairly muted. It's being treated as a signal, not necessarily what actually will get through. And that, to me, is what I'll be watching.
And I think, Jonathan, you made the point very clear earlier. It makes sense that he's doing this today, potentially as this signal you're talking about, because Modi, the Indian Prime Minister, is going to be at the White House, and there's already reports that he's coming in with a gift saying he wants to cut their trade-weighted basis tariff on U.S. imports. So potentially this is a signal to everyone else that wants to do deals with the transactional president of the United States that they need to come prepared, and this is what he's going to be looking at.
Always trying to identify those pockets of tension. Here's one. The euro against the dollar. Euro-dollar just retracing some of the gain this morning. We're down to about 103.99. Still up on the session, but not as high as we were. On a good side for the euro, the prospect of maybe some kind of peace talks between the President of the United States and the Russian President that hopefully would include Ukraine. Part one. Part two, the prospect that these reciprocal tariffs go after Europe and hit Europe hard.
What's fascinating to me is that the tension we expected to be between the U.S. and China, we expected that to be the focal point of the trade war. But so far, we've actually heard better talk between Xi Jinping and President Donald Trump. It is Europe that has been in the firing line consistently, whether it comes to tension over what's going on with the Ukraine-Russia discussions or whether it comes to tariffs. And that tension you can feel playing into this currency pair.
The only thing I will say about China is that the China tariffs are the only ones right now that have stuck. 10% additional tariffs on Chinese imports coming to the United States are the only ones that have stuck. Everyone I talk say this is an opening salvo. At the same time, Trump is trying to use China for 2 big issues. One, the Middle East, and really trying to make sure he's clamping down Iranian crude that's only going really to China, and also putting pressure on Putin to get to the negotiating table when it comes to Ukraine.
All these things going on, and equities are going nowhere. The equity market is totally unchanged on the S&P 500. It is down by 0.02% this Thursday morning. Coming up this hour, we'll catch up with Chuck Lieberman of Advisors Capital Management as markets confront hot inflation. Don Schneider of Piper Sandler with more tariffs expected. And Adam Posen of the Peterson Institute on why the Fed is priming itself to be behind the curve. Do not miss that conversation. We begin this hour with stocks little changed ahead of another round of economic data. Chuck Lieberman of Advisors Capital Management saying interest rates are likely to rise further, likely breaking 5% for the 10-year this year. With such countervailing forces, it is very doubtful stocks can repeat the large gains of the past 2 years. Chuck joins us now for more. Chuck, welcome to the program. If we can just take the last 24 hours as an example to talk about. Bond yields rose by close to double digits on a 10-year, and the equity market dealt with it okay. What is it about that you think ultimately changes?
Well, I'm not sure it does change. The market understands what's going on with the economy. We see that economic growth is very solid. There are a lot of questions about why the Fed lowered rates when it did in the late stages of 2024. And looking ahead, it's likely that inflation is not going to continue to moderate as the Fed hopes and forecasts. Instead, the market sees what's going on, sees the labor market. You've had people on talking about tariffs, working against inflation. So I think investors understand what's happening. And as things play out, they'll react to surprises. But so far, there really haven't been big surprises.
So, Chuck, right now, the 10 years at 460. If we get to 5% and break that level in a manner that you well expect, what do you think that means for equities?
Well, it also depends on how we get there. If we see some really big increases in inflation, that's going to be very disturbing. We'll get there very quickly. That would be very damaging to stock prices. We'd see a sharp downward move in stock prices. But if we do it gradually and That seems to be the more likely course. We're not going to see a surge in inflation. So I think that would be manageable. And I think that's kind of what the market's expecting.
Chuck, we heard yesterday from Fed Chair Jerome Powell, who said there is no evidence that long rates went up because of inflation. Do you agree with that?
Well, why did they go up then? The deficit is well known. It's huge. They continue to come to market. We see that. We know that. Inflation is the potential for more surprise. The Fed's been telling us that inflation is headed towards 2%, although they don't think that will get there very quickly. But there's no doubt that investors have no confidence that that's going to happen. There's no reason to think that's going to happen, especially with the unemployment rate ticking down, job growth being solid. I just don't see it.
You know, the reason why I ask is because right now it seems as though whether it's talk about tariffs or whether it's talk about the deficit and what's going on with Fed policy, there is a lack of understanding around inflation, where we are, what causes it, how much we're going back to something of a low inflation type of rate. How do you immunize what you invest in to all of those potential variables at a time where it's clear we don't have a sense of exactly where inflation is going to be, but companies are still delivering earnings?
Yeah, and because companies are delivering earnings, that's a solid foundation for the stock market. One of the places we are looking to invest is companies that are, shall we say, leveraged to inflation or immunized from inflation. So companies that own tangible assets, real assets, where higher inflation actually benefits them. A perfect example of that would be oil and gas pipelines. Those are hard assets. Inflation enables them to raise tariffs on the transportation charges. They become more profitable. They've got financing costs that have been locked in place. Those are fixed, so their profitability improves. The same kind of analysis applies to real estate investment trusts. They also own tangible assets, and higher inflation pushes rents up. But their biggest cost is their mortgage expense, again, which is fixed. So there are ways to play this to benefit from inflation.
You know, you talk about some of these areas that are often thought of as interest rate sensitive. Are they no longer interest rate sensitive because of terming out their debt? Or are you saying that this economy has a neutral rate actually far above what we see right now at a time where we're able to continue to grow at 2.5% to 3%, even with where we are?
Lisa, I think you hit the nail on the head. We do have a higher real rate or equilibrium real rate. I think it's incorrect to think that real interest rates are restrictive, which is the position the Fed has taken. They do that by looking at the cost of overnight money relative to inflation. But long rates are the key interest rate. That's the one that determines capital investment decisions, affects mortgage rates. That's the one that drives the economy. And it's hard, it would be hard to make the case that real long-term interest rates are a problem for the economy. The economy has been doing quite well, even with prevailing interest rates. So I just don't see that.
Right, but we do know that this administration is targeting a lower 10-year yield. Do you think their policies match what they'd like to see?
Everyone engages in wishful thinking, and the Fed is engaging in wishful thinking, thinking that inflation can come down to 2% in the longer term. The administration would like long-term interest rates to go down. I would like to play quarterback for the New York Giants. None of that's going to necessarily happen.
The Jets need a new quarterback, Chuck. Maybe we can make that happen. Chuck Lieberman.
I think the Giants do too.
Chuck, appreciate it, sir. Thank you. Chuck Lieberman there of Advisors Capital Management. We'll have a conversation about what it would take to raise interest rates a little bit later this morning when we catch up with Adam Posen, so look out for that. Matt Lazzetti and the team over at Deutsche Bank put out the note just yesterday. What would it take? They say this, Bramo. Downside risks to the labour market need to be extinguished. Core PCE inflation would need to accelerate towards or above 3% in year-over-year terms.
And Steve Ricchiuto was talking about the unemployment rate as well, going down to 3.8%, which isn't that far from where we are now. Key question will be how some of the policies that we've been tracking really affect this, whether it's tariffs, whether they're gradually put on. That actually might be more inflationary because people could absorb the prices. And then immigration, how much that restricts the supply of workers coming into the country.
More tariffs are coming, apparently. In the equity market on the S&P, we are totally unchanged. Let's get you an update on stories elsewhere. With your Bloomberg brief is Danny Berger. Hey, Danny.
Hey, John, a look at that post from President Trump. He is expected to announce a round of reciprocal tariffs today. On Truth Social, the president saying that today is the big one after promising to approve measures sometime this week. According to the White House schedule, Trump is set to sign executive orders at 1 o'clock Eastern ahead of meeting with India's Prime Minister Modi. Elsewhere, President Trump's voluntary resignation program has officially closed with about 75,000 opting in. That is short of the White House's goal of 5 to 10% of the 2.4 million civilian federal workforce. The plan allows workers to leave their jobs in February but stay on the federal payroll through September. Egg prices surged 15% in January as the bird flu killed millions of chickens. Prices are up 55% compared to last year and broke a record in recent months, with the cost of a dozen averaging out to $7.34 nationally. The White House National Economic Council director said that the administration is working on a plan to address bird flu. And that's your brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes. The news flow at the last 24 hours, remarkable. The next 24 hours might be no different. Up next on the program, reciprocal tariffs on the way.
We'll be signing reciprocal tariffs. The world has taken advantage of the United States for many years. They've charged us massive tariffs that we haven't charged them.
In just a moment, we'll catch up with Bloomberg's Tyler Kendall and Don Schneider of Piper Sandler from New York City. This is Bloomberg. Euro dollar intraday getting absolutely whipsawed. Right now off session highs, euro dollar 103.90. Here's the why. Under surveillance this morning, reciprocal tariffs.
We'll be signing reciprocal tariffs. The world has taken advantage of the United States for many years. They've charged us massive tariffs that we haven't charged them. And as you know, I just did something on steel and aluminum, 25%. That'll go up at some point, but 25%, which will level the playing field quite a bit.
So here's the latest this morning. President Donald Trump announcing reciprocal tariffs are coming, posting on Truth Social, quote, 3 great weeks, perhaps the best week ever, but today is the big one, reciprocal tariffs. Tyler Kendall joins us now from Washington for more. Tyler, just what can we expect and when can we expect it?
Well, John, President Trump has said that this idea for him is simple. If they charge us, we will charge them. It doesn't appear that off the bat there would be any exemptions, although we are trying to figure out if some countries or perhaps some industries might be exempted. There is preliminary reporting that House Speaker Mike Johnson has suggested that there's been some meetings that some industries, including pharmaceuticals, might end up getting an exemption. So big question still there. But what we do know is that White House Press Secretary Caroline Leavitt said that she does expect these tariffs to go into place before India's Prime Minister Modi lands here or comes to the White House later today. That welcome ceremony is scheduled for 4 p.m. Eastern. We do know from the official White House schedule that President Trump is expected to sign some executive orders at 1 p.m. Eastern. So we'll be watching the clock around that time if there will be any further guidance, if that is when he ends up signing these tariffs.
Tyler, let's sit on India for a minute. A trade-weighted basis, India's rate is about 12%. The U.S. is 2.2%. What can we expect out of this Trump-Modi meeting?
Right. Well, we are expecting, of course, tariffs to come up and what this could mean for the future of trade relations here. We know that ahead of this, India was already looking to start slashing some of its tariffs, including on everything from motorcycles to luxury cars, in a bid to try to appease President Trump ahead of this meeting today. We also know that they're looking to boost U.S. exports to their country when it comes to LNG and also purchasing defense weapons from the U.S. It is very clear that these negotiations were beginning before Modi even got here on the ground as he tries to make this bid to lessen the blow when it comes to these anticipated reciprocal tariffs. Of course, Bloomberg Economics estimating that it is these emerging economies that will likely face the brunt of them once they are implemented.
Tyler, thanks for jumping on for us this morning. Appreciate it. Tyler Kendall from the nation's capital down in Washington, D.C. To extend the conversation, joining us now is Don Schneider of Piper Sandler. Don, welcome to the program. I'm sure you heard the words of the President of the United States. Today's the big one, reciprocal tariffs. Who's the big target of those tariffs?
Yeah, good morning. Thank you for having me. Of course, India is going to be a primary target. I would expect Brazil as well. The EU, Trump has a lot of issues with. There's a range of countries there. The way I see it, the Trump administration has kind of two approaches. One is where you threaten tariffs in order to get non-tariff or non-trade concessions, like what we saw with Canada and Mexico. And then there's a broader effort towards an industrial policy, revenue collection, and onshoring. I see this kind of reciprocal tariff as kind of fitting in between a bit of both, where if you threaten the tariffs, Trump is more than happy to put them on. And if other countries want to lower their tariff barriers, then great. If not, I think he sees these as corrective for the existing trade imbalance. So I think there will be some cases with reciprocal tariffs where they will come on, and other countries will lower tariff barriers, and others where we will end up with structurally higher tariffs.
Don, but what kind of process is this? We still don't have a confirmation yet for Commerce Secretary Howard Lutnick, and Jamieson Greer is not in the job either to lead the USTR. When Trump is talking about reciprocal tariffs, would this fall under 301 at USTR?
It doesn't sound like that. I think eventually in some cases, but if Trump is saying, with these tariffs are going to come on right now, you need a much more, urgent or expedited process. So in the same way that he used IEEPA in order to levy tariffs on China, and they came into effect very quickly, the 301 process, you have to launch an investigation, and that takes time. So just based on the way they're discussing it, he may be using some authority to enact them very quickly, such as IEEPA or Section 338 of the Tariff Act. So it's unclear. It may well be the case that for this first round, they're being levied on, say, India in a manner that is very quick, or perhaps they're being announced, and then in subsequent rounds, they will launch the 232 or the 301 investigations and proceed that way.
What are you expecting in terms of retaliation from these countries, say India, Brazil, or the EU?
So far, the fact pattern has been to kind of target quintessentially American production, things like bourbon or cranberries or U.S. cars. I presume you would do something like that, try and pick targeted goods that elevate the pressure on, say, Republicans for, members to feel it in their districts, or things that are kind of economically consequential, things that we are reliant upon. You've seen China respond to tariffs by targeting or prohibiting the export of rare earth minerals, things like that. So I think you would want to kind of pick an asymmetric target that has relatively high pain for the U.S. without as much consequence for the country that is being tariffed.
Don, how long could these negotiations take? I was just looking at India's list of tariffs on hundreds of goods. There actually are different rates that change from year to year. It's a legacy of the British colonization back when they used trade practices to exploit different natural resources. How long could it take to negotiate all of this?
I think over the course of several months would be plenty of time to negotiate some sort of resolution in which we end up with lower tariffs.
One of the big questions has been how much of this is to raise money to offset some of the tax cuts that are expected to be passed. How much do you expect tariffs to be used as a revenue generator in addition to all of these other goals? Really, the question being, is the goal structurally higher tariffs in and of itself?
I think the latter. I don't think tariffs are going to be a meaningful contributor to this budget reconciliation process. So first of all, as a matter of scoring, if you don't legislate the tariffs in the legislation, they don't count for what ultimately matters, which is budget enforcement purposes. What may happen is, the legislators will take what Trump does with tariffs or have some hypothetical scenario. They'll ask CBO, the Congressional Budget Office, to produce an estimate of those tariff revenues, but they won't count towards the score. Moreover, I think the members who are sufficiently concerned about deficits aren't necessarily placated by tariff revenue. I think the Freedom Caucus members who are most concerned about deficits, they want spending cuts. They're saying substituting tariffs for spending cuts doesn't really fix their problem, which is they want lower spending. So I think tariffs are going to be more important after the fact, and or from President Trump's perspective to say, I didn't add to the debt. We had some spending cuts, plus we had tariffs and faster growth. But I don't think they're going to be very important in the budget reconciliation process.
Well, in this budget reconciliation process, we do have a budget. Thank you to Speaker Johnson yesterday. But Don, can it even get out of committee?
I think so. The way I would think about this exercise, they're looking at extending the tax cuts for around 10 years. And on the flip side, they're pursuing $1.5 trillion minimum in deficit reduction. President Trump has taken Social Security and Medicare off of the table. There's not going to be any cuts to veterans benefits. So what's left over? There's about $16 trillion and mandatory spending as opposed to discretionary or interest costs. So there's a total pool of $16 trillion in savings over the next decade. They're trying to cut around 1.5 trillion. That's 10% of all of what's left in government. I think those are substantial savings. There's not going to be a better opportunity for Freedom Caucus members or others to do this. And look comprehensively at what they could sign. They could sign into law a generational investment in border security, about $200 billion there, another $100 billion for national security procurement. That would be a substantial investment. Extend the tax cuts, add more cuts on top, because there's actually substantial room in the reconciliation instruction to do that, and get the first changes to entitlement spending, such as Medicaid, in a very long time. So in the end, I think they will come around.
When you say adding more tax cuts on top of that, do you mean no tax on tips?
I think that's one of the more likely options. I think the way to think about it, the Ways and Means Committee has been given an instruction to cut taxes by no more than $4.5 trillion, extending the existing tax cuts over the 9 years that they will count in this budget window is about $4.1 trillion. That leaves $400 billion left to cut taxes. In addition, if what the Ways and Means Committee finds offsets in its jurisdiction, such as rolling back the renewable subsidies in the IRA, that could add hundreds of billions and more room to cut taxes. So yes, I would expect no tax on tips be a high priority for the Trump administration. Some SALT relief, you would expect some kind of pro-manufacturing incentive, whether that's the 15% rate for domestic manufacturing or full expensing for structures on certain manufacturing structures, things like that. I think would be the net new tax cuts on top of the existing extensions.
Hey, Don, appreciate it. We've got to leave it there, sir. It's good to see you. Don Schneider there of Piper Sandler. That tax effort, of course, will complement in some way the tariff effort. So let's talk about the tariff effort. This just dropped from Capital Economics, and it echoed some of the words Don used there. If the Trump administration pursues a reciprocal tariff strategy rather than a 10% universal tariff, then it could result in a smaller rise in the overall effective tariff rate than we've assumed. Point one. Who's exposed? We've talked about these names, India, Brazil, Turkey too. They go on to say, though, it's probable that their governments, among others, would provide concessions to President Trump in an attempt to prevent reciprocal tariffs from being imposed. Now, India keeps coming up. The fact that Modi is meeting with the president today, and we could see this announced hours before they talk, is kind of amazing.
It shows that this might be the template, as Annmarie was talking about, that you say, excuse me, this is how you can appease us. Please cut your tariffs, and then going forward, we're not going to threaten you and we can work together and it's good baseline.
It's almost like he's producing a show today. Come out with all the threats. Modi walks into the West Wing. They have this Oval Office meeting. Everyone talks tough. Modi, according to the reporting, is ready to come with these concessions and say, I'll cut my tariffs. Maybe I'm going to buy some more U.S. aircrafts. And then guess what? They're not on the other end of those reciprocal tariffs anymore. Now he's focused on Brazil or the European Union or Turkey.
I'm not going to pretend I know what's going to happen later on this afternoon because I've got no idea. Absolutely no idea.
I'm speculating.
Well, when does the focus start to go to, can the U.S. produce all of the goods that we potentially would be exporting and that we potentially would need to produce for ourselves if we weren't importing some of those goods?
Well, that's the supply side response they want. But as you know, Lisa, that's going to take time. Could take years. Could go beyond a second term for President Trump.
I think that needs to be more of a focus. That could be a stimulus. It could also be something that juices inflation. It's something we've got to think about.
If you want that grand realignment, it's not going to happen overnight, that's for sure. Up next on the programme, Andrea Guerzoni of EY on growing confidence among global CEOs. That conversation up next. "60 minutes from now, we get some PPI data and jobless claims as well, so look out for that. Then later on this morning, we're all waiting for the same thing, a new tariff announcement from the President of the United States. Going into that, equity futures doing okay, just about unchanged on the S&P 500, just about positive on the Nasdaq 100, up by 0.05%. With 2 hours until the cash open, with your morning movers, here's Manus Cranny. Morning, Manus.
Jonathan, Cisco delivers despite the prospect of those tariffs hitting margins. So good that they've upped the guidance by $1 billion to $56 billion for this year. You can hear the wheels of AI churning out the money. This is about monetization. AI is becoming more pervasive, and we're going to surpass the $1 billion in AI infrastructure spend. MGM, let's all go to the casino, whether it's in Las Vegas or in Macau. Strong bookings, strong slot growth, China, record year for them on Macau. So a nice set of numbers for them there. Up just under 10%. I love this story on Lieberman. Love it. The stock was up 700% last year. This is the personification of the monetization of AI within advertising. You advertise directly to customers. You need a smart app to help you target your TV advertising. And this company is delivering on that. Ad sales up 73% year on year. And indeed, it is all looking pretty rosy for them on the forward guidance. Jonathan.
That stock is flying in the pre-market. Maris, thank you. It's up by 27% in early trading. Let's get you some top stories on our radar this morning. President Donald Trump announcing today is the big one. In a post to Truth Social, Trump says reciprocal tariffs are coming after promising action sometime this week. The president is expected to sign executive orders at 1 p.m. Eastern time.
And you could expect concessions almost immediately from at least one of those countries that is going to be talked about today when it comes to reciprocal tariffs. And of course, that's India, with Prime Minister Modi set to visit Trump at the White House today. And what line just drops off right now in the terminal? Minister from India, the energy minister. Qatar, U.S. and Russia have offered India more LNG. Looks like India is willing to buy more Russian energy. They have already been making concessions leading up to this moment, and I'm sure today they'll come with more gifts.
I'm trying to understand the structure of this. Is the goal to reduce tariffs across the board, or is the goal to increase tariffs across the board and increase U.S. domestic manufacturing and production? Which is it? Is it to actually increase free trade in a pretty democratic way, or is it to raise revenue and potentially reignite some of the domestic manufacturing base? Yes, I guess. I'm not sure.
Remember the Oprah Winfrey election when it was spaghetti at the wall for taxes and all these ideas? This has more teeth to it. So let's say it's cannonballs. Some are going to land and some may not.
Yeah, I just keep going back to the ultimate goal. Are we reframing the whole world economy toward a pro-tariff type of walls up, get more sort of national dependence, which you're seeing? Or is this, let's get rid of all tariffs and foster free trade?
I thought you were going to say you get a tariff, you get a tariff, you get a tariff.
Reciprocity.
That's where you were going.
I hear that time and time again from people of this administration, off and on the record. Reciprocity, that's what we're after.
There's different objectives here, let's put it that way. We'll talk about them in just a moment. I want to turn to this story. President Donald Trump and Russian President Vladimir Putin agreeing to start negotiating on an end to the war in Ukraine. Trump saying on Truth Social he had a, quote, lengthy and highly productive phone call with Putin.
So this is the start of these negotiations. Trump said he wanted to end this war. A lot of criticism coming out of Europe after Defense Secretary Pete Hegseth is in Europe saying that NATO is not going to be a part of this. So for me, this feels like Trump is giving some sort of olive branch to Putin. He said a lot about that call, though. Not just that the two would likely meet in Saudi Arabia, which seems as a neutral ground for both of them, but also maybe Trump would go to Russia and Putin would come to the United States at some point. We are in a completely different era of U.S. foreign policy than we were even 2 months ago.
And it's leaving people in the European Union very concerned that they don't have an understanding of exactly how this is going to play out and whether they've got a seat at the table. Again, this goes back to the lack of leadership there, a lack of a clear view of how this progresses, a lack of a plan, and what they're willing to do. Are they willing to put peacekeeping troops in there? Are they willing to pay 3.5% of their overall GDP on defense spending? These are some of the questions percolating in that region.
I'll try and save my opinion on this occasion.
Oh, you have?
Okay, on this occasion.
You can just rewind a little bit.
On this
and you
occasion, maybe an hour ago. But on this occasion, I'll just focus on the markets.
Okay.
What anyone thinks about the deal, the euro's stronger and crude was lower. And isn't that ultimately an endorsement of the deal from a market perspective on what Europe would need?
From a market perspective, it is ironic that this essentially is foisting the need to borrow potentially $3 trillion on the euro region that could potentially spur growth, that could potentially be exactly what the region needs to get out of its slow growth, slow evolution.
We've said this before. Perhaps these moves by this president forces the Europeans to do things that's actually good for them.
Yeah, it's the reason why it is such a difficult moment to invest, because then at the same time you can wonder if you get growth, well, what does that mean for the debt scenario and what the ECB can do? I mean, you start pushing this down, it's premature. Let's see if they get a deal done.
Let's talk about the Fed as well. Fed Chair Jay Powell wrapping up his two-day congressional testimony, telling the House Financial Services Committee that yesterday's CPI print means the FOMC has more work to do. We've got more data on deck. PPI and another round of jobless claims come in about 55 minutes' time. I have to say, listening to the Fed Chair, he didn't sound particularly vigilant when it came to inflation, with words like, I would say we're close, but not there yet. on inflation.
Yeah, and when he talked about we don't get excited about one or two good readings and we don't get excited about one or two bad readings, dismissing the January data is almost an aberration. And sure, there was plenty of discussion about weather effects really distorting things. That said, it has been 3 months of annualized inflation of about 4.5%, which is the fastest pace of inflation for a 3-month period going back to November of 2022. It feels like something more than a blip at a time where he's saying inflation expectations aren't responsible for the 10-year yield going up. We're still kind of on that steady disinflationary path.
I picked up on what you said earlier, and it's interesting. Playing down his contribution, the committee's contribution to the pickup in yields at the long end, when inflation expectations bottomed in the last 12 months around mid-September, which was shortly after we had that pretty aggressive speech in Jackson Hole, and just before we got a 50 basis point rate cut from the committee, which was followed up by another 25 and another 25. The yield curve steepened through last year, not just because of the tariff story and a Trump win and this pro-growth effort that everyone was expecting that could trigger reignite inflation. It was also much looser policy than expected from this committee.
What people were talking about was the likelihood that we could see real inflation coming down the pike from some of these policies in a way that would test the Fed's hand. He said, just to quote exactly what he said, no evidence long rates went up because of inflation. You did see real rates go up. This was a nod to maybe the deficit discussion. Either way, a real question of how to be political without being political by saying, maybe it's not, I don't know. Go take a look at yourselves.
That's when you want an interview, right? You want to have that follow-up
question.
Exactly.
What are you saying it did cause it?
Your time is up.
Exactly.
That's what frustrates me about all those hearings. Let's turn to the confidence. Confidence levels are still sky high. EY seeing growing confidence among corporate leaders in the company's latest global CEO survey. Sentiment around M&A also at an all-time high. Andrea Guerzoni of EY writing, there are indications that 2025 could see an uptick in mega deals, with 60% of global CEO respondents expecting to see an increase in deals more than $10 billion. Andrea joins us now for more. Andrea, welcome to the program, sir. Let's talk about the kind of deals that you and the team are looking for. What are we expecting here? Vertical deals or the kind of horizontal deals that were difficult to make happen over the past few years?
I have to say that it's difficult to say. There's a bit of uncertainty that is kicking in the last couple of weeks. Since we launched the survey, I think there's been a quite change in the landscape. But it's true. I mean, if you look at our confidence index, 74% of our CEOs are more confident that they will be able to navigate all this uncertainty. And those that are more confident have more appetite for deals, including mega deals. So that's really the outcome of this survey. And we expect really that in certain sectors, there will be search for new technologies and for opportunities to scale up. So we remain quite bullish, actually, despite the month of January, which has not been great in terms of deal activity.
Well, Andrea, you alluded to it. Let's unpack that a little bit more and build it out if we can. What do you think could possibly be holding activity back at the moment? What is it? Is it policy? Is it interest rates? What do you think it is?
It's all of this. I mean, if you look at the different forces that are shaping the M&A activity, I mean, we have a quite colorful patchwork of forces that are actually pushing for more deal making. I mean, there's a huge amount of dry power in private equity hands that needs to be invested. I think overall, the geopolitical situation, although remains very concerning, shows actually signs of improving. And if you look at the state of the U.S. economy, which is where the vast majority of the M&A activity actually happens, actually looks bright. Then you look at the other side of the coin, and you see that during the last 30 days, the amount of uncertainty regarding policies, tariffs, taxes are impacting really trading flows and then capital flows as well. Interest rate is another fundamental driver to push investment. And interest rates is related, as you well know, to inflation. And inflation is still very uncertain. Actually, the latest data from the U.S. Are pointing to a slightly increase instead of decrease. And this is causing uncertainty regarding the cost of capital, which may slow down the M&A activity. So you can see it's a very mixed picture.
Andrea, I want to pick up on one aspect that you just said, which is that the U.S. is where the bulk of the M&A activity is happening. Is that more than it has been in the past? Is it sort of the sucking sound of the U.S. and the growth story taking a lot of the energy from the M&A story, or is it pretty much the way it's always been?
It's pretty much the way it's always been, but with a big but, it's growing. If you look at the numbers, I mean, in January, the deal activity, I think, marked a $240 billion value, and almost 61% of this actually was generated in the U.S. It's really the sheer size of the economy, the fact that the GDP is growing, and if you look at the rest of the world, I mean, with what's happening in the UK, in continental Europe, you look at the economies in France, in Germany, and the situation in China, then you see why this proportion is increasing.
Andrea, is this a response to some of the policies that are coming out of the Trump administration, almost to act as an insurance policy that if you have some sort of footprint in the U.S., that will protect you from some sort of tariffs? Or is this purely on the pro-growth story that we're seeing coming out of the United States?
I think the overall sentiment this administration is pro-business, which helps. I think it's the stability of the overall U.S. environment. But I think that one of the most important angles for deal making, which again is a trend that is growing and can only go up further, is really the tech angle. The possibility really through technology, through AI, you can actually increase productivity and hence accelerate value creation. And actually, the action is in the U.S. So no wonder that there is a lot of investment activity, M&A activity in the U.S., because it's where really the vast majority of tech assets, tech knowledge is residing now.
But Andrea, to Lisa's point, how much do these CEOs need to incorporate political risk? A day like today, we're getting reciprocal tariffs. No idea what exactly they are going to mean, but there's a tremendous amount of uncertainty we're hearing from even the likes of CEOs like from Ford.
I think this is obviously a significant headwind for whoever wants to invest. I mean, not having really a stable picture regarding tariffs, and it's an issue. And all the CEOs we meet and we speak with, they are really working very hard to produce scenario plannings. They cannot really wait. They really need to keep themselves and make really some assumptions regarding what the end game is. Obviously, the longer this uncertainty lasts, and the more difficult really to execute deals. But I can tell you, when we ran our survey in the last month of last financial year, there was a huge amount of optimism regarding the fact that after an initial period of, let's say, adjustment to the new administration policies, the situation would stabilize and the pro-business philosophy would actually prevail.
Andrea, before you go, I just want to double check. Are you an AC Milan fan?
I'm definitely an AC Milan fan.
There
My
we go.
family and we are struggling a bit nicely, but I mean, the last couple of players joining us are promising, so we are looking up.
Last night was tough. I watched it too. I could tell we had a connection. I appreciate it. Andrea, thank you. Andrea Guerzoni there of EY, with a lot to say on Milan, I could tell.
Yeah.
Wanted to follow up there.
Oh, yeah.
Last night wasn't good.
Clearly.
Yeah.
You lost to a
Wasn't great.
team that no one even has heard of.
Well, I'm sure the Dutch have heard of them, and I'm sure they're unhappy with that comment.
All I can say is, if you wanted to know why we had that interview, it was literally just for you to have that one moment.
Just wanted to double check. That's all.
Yeah.
I didn't know that for sure. Just you can tell.
He could have been a Juve fan.
What was the give?
There
What
was
was
just
the
a
tell?
connection between us both, and that's what it was. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Unfortunately, I have some more football news for you, but we'll get to that at the end. Elon Musk called to delete entire agencies from the U.S. government during a video call to the World Government Summit today. Since leading Trump's Doge, Musk has been vocal about reducing costs and improving government efficiency, most recently furloughing the majority of U.S. aid staff and freezing its funding. Blue Origin plans to cut potentially more than 1,000 employees. Sources tell us that the Jeff Bezos-backed company is looking to cut costs and focus resources on ramping up rocket launches after years of research and development. The space company's CEO plans to discuss the cuts at an all-hands employee meeting today. And as promised, the final Merseyside derby at Goodison Park was one to remember. Everton's James Tarkowski scored the final tying goal in the 98th minute, stunning the Premier League's title favourites Liverpool. A brawl then ensued after the final whistle, with 4 red cards issued, including one to Liverpool's manager. Liverpool's lead over second-place Arsenal now sits at 7 points. And that's your brief. John.
What a finish. Best game on the planet. If you haven't seen it, watch the end of that game. Did you watch the clip last night?
Yes. Man, the eruption. I thought
very unhappy house.
I thought that the stadium would absolutely collapse.
Liverpool fans at Bramall's Place, just in case anyone's wondering. Up next on the programme, the Fed's long pause.
At face value, this is certainly not good news for the Fed. Look for the Fed policy not to act as an anchor for this economy, but to fuel volatility further. The pause button is going to be on a lot longer than what the market has been expecting.
Just a moment, don't miss this. We'll be catching up with Adam Posen of the Peterson Institute. He joins us next on the prospect of rate hikes in 2025. Equity futures on the S&P a bit softer here by 0.1%. In about 40 minutes' time, we'll get some data for you. We'll get PPI and jobless claims. Look out for that. Going into it, bond yields lower by 2 basis points. The 10-year 459.74. Under surveillance this morning, the Fed's long pause.
At face value, this is certainly not good news for the Fed. If we could talk about what is the right inflation target for an economy going through massive structural change, it would not be so obsessed with 2%. It will be flexible. There is no meaningful forward policy guidance coming from this Fed. And that is the mistake. Look for the Fed policy not to act as an anchor for this economy, but to fuel volatility further. The pause button is going to be on a lot longer than what the market has been expecting.
So here's the latest this morning. Markets bracing for President Trump's reciprocal tariff plans and its inflation impact after a hotter than expected CPI report just yesterday. Adam Posen of the Peterson Institute writes he is convinced and worried that they will put across the board 15% tariffs and allow Trump to go up from there. Notwithstanding Powell's we have to wait and see attitude, this will be inflationary unless it provokes a recession. Adam joins us now for more. Adam, welcome to the programme, sir. I just want to unpack that quote piece by piece. Can we start with the Powell piece of it? The Powell's we have to wait and see attitude. Do you think that's contributing to higher inflation expectations?
Yes, I think it is, John. I think it's clear. I mean, you and I and Lisa and Annmarie have been talking about this for months. I agree with one piece of what Mohammed said. There's no forward guidance in a meaningful sense from the Fed. Forward guidance can be cheap talk, but this data dependency, short-term, misleading things. I mean, the idea that they were so convinced that the unemployment rate was a be-all and end-all measure of the state of the economy when all the evidence was otherwise. It's just a series of not the worst mistakes, but not good. Now, is there a huge erosion in inflation expectations compared to the past? No, but just as we remember with Volcker 40 years ago, when you didn't kill it in 82 and you let it get back in 85, it was hard to kill the second time, and that's what we have to worry about.
Adam, a lot of people have come on this show and made the argument that tariffs are a one-time price adjustment, but otherwise are disinflationary on the margin over time as they do reduce demand on the margins. What's your evidence, or why do you think this time is different, that the tariffs that Donald Trump is proposing to implement will actually have a significant inflationary impulse?
Lisa, I think there is a chance that it is more recessionary than inflationary because it is a tax hike, and it's a tax hike in particular on consumers and high-end businesses at the end of the supply chain. It also potentially could cause trouble by recessionary type trouble by creating shortages or unavailability of certain goods between retaliation and tariffs and other disruptions. But in the broad, in theory, it's a relative price hike. But in practice, what we've seen in country after country in the U.S. in the past is that companies do have a certain amount of pricing power. It's not greedflation, but they're not going to passively sit there and let the price hikes made to them go unanswered. And additionally, we know that there is multiplier effects, that you start off, you're putting taxes on something that's a basic input like steel or aluminum or chips for that matter. And then it cascades up the value chain and up the goods being sold. So it's, in theory, you could always have it be just a relative price shift, but then in practice, it's very unlikely. Finally, what you just said is if inflation, or Jonathan raised, if inflation expectations are a little bit flexible or uncertain, that makes it more likely that when you get a price shock, the Fed cannot just look through it.
Adam, if today is a template, the threat of retaliatory tariffs could prompt a lot of trading partners to actually come to the table by reducing their tariffs. How much are you looking at just this being a rearranging of trading partners more than, say, an increase in tariffs if it actually leads to lower tariffs in certain locations?
That would be fine, obviously. I mean, if the piece of this that is difficult is that would mean the U.S. would eventually take off its tariffs to match and incentivize and lock in where others take down their tariffs. And so it would not be the nicest way, but it would be a way to get further trade liberalization. And so that would be fine. But
well, Adam, one thing
there's very little evidence that that is the intent here.
Well, it might be, though, right? One thing I continuously hear from the Trump administration is reciprocity, reciprocity. March 12th, that's when those tariffs will come on for aluminum and steel. So there's a pause on that. March 4th. Potentially, we don't know what's going on with Canada and Mexico. April 1st is really the memorandum when it comes to looking at these trading partners. At the moment, besides China, isn't this still in the negotiating phase?
It's in the threatening phase. So we'll see whether it's negotiating or threat. Either way, again, one always is glad when somebody does a bad policy. It removes a bad policy. So if the Trump administration, despite the president's statements, despite Peter Navarro's statements, despite everything they've been saying, this ultimately is just a gambit to get tariffs reduced abroad. And as Lisa said, it just reshuffles who you're trading with. Fine. I mean, it's not great. It's uncertainty. It's a little bit of government intervention and pricing that we don't really need, but fine. I'll be very happy if that's the outcome.
We'll see what the outcome is. Adam, thank you, sir. Adam Posen there of the Peterson Institute. Adam, who's just been phenomenal on the Federal Reserve, tracking back to August of last year. And for those of you not familiar with the way Adam's been thinking about things, came out in August of last year, wrote a piece and said, basically, dear Chairman Powell, as you get together in Jackson Hole, think about what you're about to say and prepare this market for two-way risk, because there could be some real two-way risk. Let's just say that Chairman Powell focused on one-way risk and it was downside risk to unemployment, or rather employment.
And then had to walk that back. And now we're looking at the fastest three-month average inflation going back to November of 2022. Adam Posen was the one who said the next move could be a hike.
Yeah.
You see hear an increasing number of analysts saying the same around this table.
Came out so early saying that, and credit to him. Up next on the programme, Bob Diamond of Atlas Merchant Capital, Tom Narayan of RBC, Andrew Hollenhorst of Citi, Brian Weinstein of Morgan Stanley. Lots of data, 34 minutes away, PPI and jobless claims.
Right now, I would describe the data as somewhat concerning, but not overly concerning.
At face value, this is certainly not good news for the Fed, and the bond market and the equity market is reacting accordingly.
They shouldn't overreact to this, but at the same time, they say there's nothing here which says that inflation is cooling.
The prospect for further rate cuts has diminished considerably.
Markets love certainty. They love predictability. We don't have that at the minute.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Equity futures this morning, and good morning. Slightly negative, down by not even 0.1%. No drama on the S&P 500. No drama yesterday either, and we can talk about that later this hour. On the Nasdaq 100, we're positive by 0.06%. In 30 minutes' time, you'll get some economic data, PPI and jobless claims. Look out for that. And later, executive orders coming from the President of the United States at 1 p.m. Eastern Time. Either at that time or shortly before, we don't know. We might get this. We might get the big one. In the words of the President of the United States, reciprocal tariffs.
Which people have been waiting for, but expand out the potential parameters of not just where tariffs will go, but also how specific they are going to get for specific line items. This comes before his meeting with Modi of India. A bigger question from a market perspective is, are people going to look past this because the details are just so difficult to wrap your head around? So just watch the economic data, ignore that until it becomes real policy.
And look past it, because what Adam Posen said was we're in the, quote, threatening phase. That's what he called it, as part of these maybe negotiations or warnings to other countries where the president feels like there's not a fair balance of trade. I maintain that given all of these tariff headlines, the only one that has stayed and actually stuck and went into effect was China, 10%. Everything else at this moment is paused. And what actually the president is doing at this moment is getting concessions already for potentially one of those countries that he's going to put reciprocal tariffs on, India.
And then Europe. Europe's in mind. Check out euro dollar. Look at this round trip on the session. Now totally unchanged on the day. So on the left side, you've got this ramp up in the euro. The hopes that there will be talks between Putin and Trump. And maybe we can address the war in Ukraine. On the right side, you've got that ramp lower. You've got that prospect of reciprocal tariffs on Europe. That's the tension in foreign exchange this morning.
The tug of war of whether your region will face a growth shock to the positive or to the negative. The positive being a resolution to the conflict in the region that has really tightened supply chains versus seeing a real tax based on tariffs. What's the response? Is there enough cohesion in Europe to actually sufficiently respond to any of these threats?
They say they're going to, at least when it comes to tariffs. But when it comes to this peace agreement, the Europeans are going to feel left behind. And they already are starting to throw a lot of daggers at the Trump administration behind the scenes about this. Oliver Cook was talking about that. So I think this weekend is actually really critical when it comes to both these prospects, a peace agreement potentially and tariffs, because all of these leaders are going to be meeting at the Munich Security Conference.
Euro dollar 103.90 and just about positive by not even a tenth of 1%. Coming up this hour, Bob Diamond of Atlas Merchant Capital on the outlook for financials. We'll speak to Tom Narayan of RBC as automakers brace for additional tariffs, and Andrew Hollenhorst of Citi on why he's still looking for the Fed to cut interest rates. We begin this hour with stocks on hold, pairing most post-CPI related losses as markets adjust to high for longer for just a little bit longer. Joining us now is Bob Diamond of Atlas Merchant Capital. Bob, it's good to see you, sir. It's always good to catch up.
John, it's great to be here.
Outperformance from the financials already in 2025. Yep. You've got a big call. I want to start with your big call. We've got about 4,500 banks in this country right now. Yep. You think that can drop to 1,000 to 2,000 financial institutions in this country? That's a big move. How does that happen?
We think over the next 2 to 3 years, we're going to see a very constructive consolidation. We all know in March 2023, when SVB failed and followed up quickly by First Republic, part of that was from 0 to 5.5% in interest rates. It kind of impacted every bank's interest rate portfolio and loan portfolio. Kind of the shock in commercial real estate hit that sector. But now it's very, very strategic, Jonathan. And I think because it's strategic, it's definitely going to happen. You have many of the smaller, they've been there, the smaller, more private community banks that have been such a pillar of the community and so important to the economy in terms of serving small businesses, today are just too small to succeed. The impact of technology costs, but most importantly, the impact of the regulatory reaction to SVB in First Republic. So our view is that we're going to see the more successful, more well-capitalized regional banks have an opportunity to do business with a smaller private institution.
Is this true of the whole country, or do you see some of this activity concentrated in certain regions, certain parts of the United States?
Well, you bring up a very good point, which is much of this is about reducing costs. And if it's reducing costs, then you're going to see many in-state or close state combinations. So I think that's a good question.
One obstacle has been the regulatory environment for this type of tie-up, and the other has been valuation.
Yeah.
That people don't want to sell for what they think they're worth, if it's less than what they think they're worth. You're involved in some of these conversations. I'm sure you are, currently ongoing, and financing them, being part of them. Are people more willing to compromise on the valuation side of things now?
People are much more willing to look at the future. Whether it's a compromise, I probably wouldn't have used that word, but I think it teases out the issue, Lisa, which is it's in the best interests of these institutions if they're going to continue to compete for their middle market, small business clients, family office clients, that the ability to combine and take out costs, particularly technology costs, which are duplicated, the credit department, totally duplicated, regulatory relations, totally duplicated, and anyone that is involved in consolidation, if the synergies are cost and you can identify them quickly, it goes right to the bottom line. And so too many of the smaller banks are struggling to get their ROE above zero, frankly, but never mind 10 to 15%. And we all know that the valuation of banks is driven by the return on equity. So I think this is, we're in a situation where it's good for these banks to begin discussing consolidation.
We've talked a lot about the deregulatory push of Donald Trump and how this would really spur a whole host of growth. And the point that it's raised around this table we've talked about is how much of the activity in lending has gone to private asset managers. If some of these banks do have more strength, will they be able to win that business back? Or is it a permanently cannibalized backdrop that is not going to revert back to the way it was?
Well, first of all, in terms of regulation, we believed in this thesis strongly under the Biden administration. But the shift from the Biden administration to a much more positive SEC, I mean, the SEC under Gary Gensler was not approving anything in terms of consolidation here, in crypto, and digital. Pretty much nothing was being approved that was positive for business in terms of combinations. That's going to change. I don't think that is a cause of this, but I think it's going to be an accelerator, which is we're in an environment where the government is going to be and the regulators are going to be much more positive to constructive consolidation, which is, frankly, think about this. From a regulatory point of view, do they want more capital in the banking system? Of course. And you have institutions like Atlas Merchant Capital that are willing to put more capital for these combinations. And so it's a win-win all around.
To go back to where John began, you expect to see 4,000 go to 1,000 or 2,000 banks. Could that be in the next year, in the next 2 years, or do you see this as a multi-decade process? 2
to 3 years. I don't think it's multi-decade. I think it's 2 to 3 years. I think now is the time. I think many discussions are happening. And I think we'll see, 3 years from today, I think we'll see between 1,000 and 2,000 banks in the U.S.
But now is the time because of the policy.
The U.S. does not need 4,500 banks. Come on. Let's be realistic. And there's many. The service that these institutions give to small businesses is incredible. So it is an important sector of our economy. It's an incredibly important sector of the financial services industry. And we know those two things together are why the U.S. economy is so strong relative to their peers. So this is going to be very constructive.
It's a lot of banks. You think it can get done 2-3 years, but that is because the changing of the guard in Washington, right?
Well, I think that will be an accelerator for sure. I think the approval process, the regulatory approval process, is going to be, positive behind this initiative as opposed to a blockage. And as I said, I think strategically we felt strongly that this was going to happen over probably a little bit longer time because it's necessary. These are strong banks. They're important to the economy. They need consolidation. They need to boost their ROE. There's costs ready to come out. All of this just makes perfect sense. And I think the attitude toward combinations and toward mergers and toward business, the attitude toward bringing more capital into the market is just much more positive under this administration.
Do you see them as competitors eventually to the big players on Wall Street, or just operating at a different part of the financial sector?
Well, they're in a different part, Jonathan, but competition's a wonderful thing. Whether it's private lending competing with the banks, has that improved lending for customers? Absolutely. If you have stronger regional banks, will the super regionals be stronger and will they have opportunities? So competition's a wonderful thing. And I think it could sound like with 4,500 banks, there's a lot of competition. But if you had 1,000 to 1,500 stronger banks, better capitalized, then I think the competition would be better.
Bob, smart, as always. It's good to see you, sir.
Good to see
break
you,
this down. Thank you. Bob Diamond there of Atlas Merchant Capital with an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Serious injuries in Munich after a car drove into a labor demonstration. At least 28 people have been hurt. Local police say the driver, a 24-year-old Afghan male, has been taken into custody. The alleged attack comes after a string of incidents in recent months. Pressure is building on German Chancellor Olaf Scholz to ensure security ahead of this month's federal election. Elsewhere, President Trump is expected to announce a round of reciprocal tariffs today. Trump posting on Truth Social that today is the big one after promising to approve the measure sometime this week. According to the White House schedule, Trump is set to sign executive orders at 1 o'clock Eastern ahead of his meeting with India's Prime Minister Modi. The State Department's procurement forecast removed its plan to spend $400 million on Teslas. The December version of the document had included a, quote, armored Tesla budget item that would span 5 years starting this year. However, newer version generically says, quote, armored electric vehicles. On X, Musk said, I'm pretty sure Tesla isn't getting $400 and that no one mentioned the deal to him. And that's your brief. John.
Hey, Danny, thank you. Appreciate the update. Much more in 30 minutes' time from Danny. Up next on the programme, the Morning Calls Plus, Tom Narayan of RBC as the automakers brace for additional tariffs from the President of the United States, Donald Trump. We're looking out for those reciprocal tariffs. It's the big one, apparently, coming up a little bit later. Live from New York City this morning. Good morning. So the opening bell 1 hour and 15 minutes away. The data 15 minutes away. PPI and jobless claims. The equity market shaken up as follows. The equity market negative by not even 0.1% on the S&P. It's time now for some morning calls. First up, Bank of America double downgrading Kraft Heinz to underperform, saying it struggles to see a path to meaningful sales growth this year. That stock is down 1.6%. Your second call from Wells Fargo raising its price target on Home Depot to $450, expecting it to re-enter upward revision territory. The stock is just about unchanged. And finally, Wedbush reiterating its outperform rating on Tesla, saying the deregulatory environment will fuel the autonomous driving story. The stock is up by 2.3%. That stock has struggled over the past few weeks. Let's stick with the autos. The industry bracing for President Trump's across-the-board tariffs on all steel and aluminum imports and possibly retaliatory tariffs going on as soon as today. Tom Narayan of RBC writing, these tariffs appear to have a better chance of being implemented than last week's on Canada and Mexico. That said, most investors we spoke with do not believe such tariffs will be permanent. Tom joins us now for more. Tom, good morning. It's good to see you. That's just steel. Then we've got to think about Mexico and Canada. Now, we've also got to think about the European players and what they might face. How are you and the team thinking about so-called reciprocal tariffs and what it might mean for European autos?
Yeah, I think we saw this whole script play out in 2018, where actually none of those tariffs were actually implemented. What we wound up happening is steel and aluminum did happen for about a year, and the automakers handled it quite well. Most investors I speak with don't actually think we'll have permanent tariffs, reciprocal tariffs, etc. I mean, there's a lot of devil in the details here, but that's kind of where I think the consensus.
Can I get into the logic and just ask why? Because when we talk about this and we acknowledge that Europe has higher tariffs on than the United States, 10 versus 2.5, kind of makes sense that US tariffs come up. Why does no one believe that?
Well, because we've had evidence where it hasn't happened. Also, it's unclear that tariffing European imports would actually help the U.S. auto industry, right? So, like I've said this before, like the person buying a Chevy Silverado is not the person buying an S-Class, right? So the U.S. auto lobby isn't really calling for it necessarily.
I want to talk about U.S. automakers because the Ford CEO is making a lot of trips to Capitol Hill. He was there yesterday. He said that these tariffs would be devastating and blow a hole in the U.S. auto industry. How concerned are they about this pause we're seeing at the moment, but potentially that could hit after March when it comes to Canada and Mexico?
Yeah, I mean, obviously he's going there for a reason, right? And he's saying that it'll blow a hole for a reason, right?
But will it?
It's a political game. If they're permanent Mexico-Canada tariffs, not the steel aluminum, the Mexico-Canada tariffs, that would be a disaster. But I think what he's illuminating is a fact that, you know, in his words, how well thought out are these tariffs so far? For example, what happens to the Japanese and the Korean imports? They're not included there. So you're punishing U.S. automakers for producing in Mexico, but you're allowing the Japanese and the Koreans, right? So that's something he noted. There's also like, what happens if you produce a battery in the U.S. and ship it to Mexico to assemble a car? Is that included? So I think he's just highlighting the fact that permanent tariffs on Mexico would be disastrous. But I think that fact alone is why investors think they probably may not happen at all, because there's a lot of questions.
Something else CEO Jim Farley is talking about is the IRA, the Inflation Reduction Act. These U.S. automakers sunk a ton of capital into EV because of the subsidies they were getting from the Biden administration. And he's making the point politically that a lot of this money went to red states. What is your base case? Does some of this money stick?
Yeah, so I think we need to separate out the two parts of the IRA. One's the consumer credit, right, the $7,500 credit. That's looking more and more like that will go away. And to be fair, the Biden administration was looking to take away the lease component of that. So that was already on thin ice. But the other piece that remains is the 45X making batteries in the U.S., in, like you mentioned, red and purple states. That seems like it's probably here to stay. So it's a mixed bag. It's going to have an impact to remove the consumer credit, no doubt about it. But keeping the battery credit, I think that remains. That still helps the D3 who are doing, notably GM, that's building batteries domestically.
We've been talking about what the framework is for some of these tariffs, what the goal is. And one of the goals that we keep coming back to is to increase the amount of manufacturing in the United States. For some of these auto manufacturers, especially with the increase in automation, the fact that you can do things more efficiently, is it feasible in a way that it hasn't been, say, over the past 10 years, to increase some of the production domestically in a way that isn't necessarily cost prohibitive?
Yeah, it's a great point, right? I mean, I tour auto factories all the time. I'm sure you guys as well. You notice a lot of robots, right? Now, that said, there is an impact. I think GM had said just this week that in the near term, they could mitigate the tariffs on Mexico by as much as 50 to 60% by moving production to the U.S. Now, that's a temporary fix, right? Because what happens to those plants you have in Mexico? That's a stranded cost. And now you're overcapacitizing the U.S. production. So it's not like it wouldn't have an impact. They probably, if there are permanent tariffs on Mexico, of course they would have to reshore. It would be very costly to do so.
I guess this goes to this question of the European automakers as well, because we had another announcement today that Porsche was planning to lay off almost 2,000 roles in Stuttgart in Germany. This comes on top of the 54,000 layoffs in the auto industry last year in Europe. At what point are we talking about either an industry that's got over capacity globally, or are we talking about an industry that isn't as people intensive as it has been traditionally at a time of a lot of technological advance?
It's probably a combination of the two, right? I mean, VW had all of those discussions, to try to shut down plants for a reason. It's overcapacitized. You have Chinese competition coming in. They're probably going to have to do JVs with the Chinese companies. What does that mean for the profit pooling? They'll have to share that. Probably means you need less labor. And it's also this automation point. That is absolutely true. If you compare SG&A as a percentage of sales of the U.S. automakers, compare it to Europe, you'll notice the difference. Not just in autos, by the way.
Pop quiz. Who's got the answer to this one? Biggest automotive exporter in the United States of America. Who do you think it is?
Kia.
BMW.
Oh.
And has been for a number of years.
All right.
And that plant they've got in South Carolina is one of their biggest plants. Spartanburg. Now, why don't we ever talk about this? We should talk about this all the time. How did that happen? How did we end up with one of BMW's biggest plants, perhaps even the biggest plant, being in South Carolina? How did that happen?
Well, the U.S. is a really important market. It's cheaper to localize, closer to where your end market is. Remember, they make large SUVs there. And so does Mercedes, has one in Tuscaloosa, too. So that's where the large SUV market is the U.S. Producing locally just cuts costs.
So shouldn't we want to see more of this? Shouldn't that be the model? Ultimately, if the president wants to see more of that, shouldn't we go to BMW, work out how that happened, and figure out what we need to do to see more of it?
Probably, yeah. That's why I think what Jim Farley at Ford was saying is this hasn't really been potentially well thought out, the details like this. That could be a solution, absolutely.
And is another solution potentially vice versa? Trying to get Ford, GM to produce in Europe, sell more cars? It's a big grievance of the president.
Yeah, could be. That could be what happens. But Jim is not really in Europe. Ford is. Ford does produce there. But yeah, maybe that is something that winds up happening. You wind up producing more locally in the region you want to sell to.
In the meantime, John keeps talking about this every time we get a stock analyst, stock investor. How can you say that this industry is investable if you're not getting clear policy and you don't have a sense of how much you're going to have to rearrange? What do you tell them?
This is the question I get all the time. It's kind of like the math you have to do of, let's say there's a 1% chance of negative infinity, right? And a 99% chance of everything is fine. If you do a blended average, you get negative infinity, right? But how useful is that math, right? So you have to, as an investor, kind of look at that probability and say, this is kind of like, I used to be an investment banker, garbage in, garbage out math, right? How useful is that math? You have to potentially hedge. You have to, come up with your own call of what you think will happen. It would appear the investors I talk to don't think we'll get that negative infinity scenario. So there seems to be a lot of panicking about it, but maybe we need to kind of be more rational, like some of these investors I speak with, and think about it from a kind of a more pragmatic standpoint.
Hey Tom, always good to see you.
You got it.
Just a final question: if we get reciprocal tariffs on autos and those stocks gap lower, are you saying they're a buy?
I think so, based on what I speak with investors, because they don't think it's going to be permanent. We have evidence to suggest that they haven't been in the past.
Okay, we'll see what we get a little bit later. We'll see if it sticks. Tom Narayan there of RBC. Tom, thank you. Looking out for reciprocal tariffs a little bit later today.
To me, that was a clinic on why the market is not responding to a lot of the tariff threats. If you can't price in negative infinity, which my father is very upset about because it's not really a true mathematical concept, but carry on. If you really just bank on negative infinity. No, he's probably... he's not watching, but sorry, Dad.
He doesn't do TV.
No, he doesn't. He's probably thinking. But I just think, it sort of highlights why people discount that whole concept at a time of a great deal of uncertainty.
True, but only thing I would push back on Tom on is we're in a different political environment this time around. Donald Trump is not running for president again. So maybe he does want this global realignment on trade, and these tariffs do stick.
We're living this real time. We're going to find out, aren't we? Time will tell. Equity futures right now in the S&P 500 negative by close to 0.1%. In just a moment, economic data will get PPI and jobless claims and reaction from Andrew Hollenhorst of Citi, Brian Weinstein of Morgan Stanley. That conversation coming up very shortly. Live from New York City, to Lisa's point, this market's staring down the barrel of more tariffs and not doing much in response. Your equity market is unchanged. Real-time update from Casa Bramo. Got time for this, haven't we?
I feel like I'm in math
I don't
class.
know. We actually, evidently there is something that can approach negative infinity as the sequence gets smaller and smaller. We are 15 seconds away from key economic data. This is unnecessary.
Love that.
Sorry.
That's perfect. Your scores look like this in the equity market. We're negative by about 0.1%. In just a moment, PPI and jobless claims. Breaking down that economic data. Let's get to Mike McKee. Good morning, Mike.
Good morning, everybody. Well, we've got the PPI numbers coming in hotter than anticipated, much the same as we saw with CPI yesterday. Final demand headline number up 0.4 on the month. So on a year-over-year basis, we're at 3.5%. Ex-food and energy, 0.3. The forecast was for 0.3, so that one's online. But remember, last month it was 0. No change. So on a year-over-year basis there, we're looking at 3.6%, up from 3.5. And then the ex-trade numbers up 0.3, which is more than anticipated, and that puts us at 3.4%, up from 3.3. So we are seeing some pipeline inflation pressures. We'll have to take a look at what those came from. Jobless claims, though, better news. 213,000. Last week's 219 revised up to 220, so it's a drop of 7,000 overall. 1,850,000 on continuing claims, down from 1,886. So the jobless claims side of the Fed's mandate doing okay. The inflation side, still a bit of a problem.
Mike McKee, thank you, sir. Stay close and we'll get some of those details in just a moment. So that's the right kind of downside surprise on jobless claims and the wrong kind of upside surprise on PPI. Off the back of that, Treasuries cheapened just a little bit. Yields were down by a few basis points, now down by just 1 on the long end on 10s. At the front end, now just about unchanged on the session. Off the back of that, the euro, a bit more weakness against the stronger dollar. Euro dollar down to 103.82 and now totally unchanged on the session. And in the equity market, looking at S&P S&P 500 futures holding on to very mild losses. We're down by about 0.1%, and the Nasdaq 100 just about unchanged. So, Lisa, that's an upside surprise on CPI, followed by an upside surprise on PPI.
And this really feeds into that core PCE figure that Jay Powell was talking about yesterday, that they tend to look at to determine whether or not to adjust policy. I'm surprised there isn't more of a reaction in the bond market, I'll be honest, on the short end. So I would like to look through some of this and see what people are looking through. If you take a look across the board, not only is it above expectations with inflation PPI, but the revisions also are to the upside pretty much across the board, which again speaks to this question of why aren't we getting more of a pop in that two-year yield?
Well, if you are just tuning in, welcome to the programme. We do get hotter than expected PPI, an upside surprise there almost across the board following an upside surprise on CPI just yesterday. Mike McKee is still with us. Mike, you've had a chance to go through the details. What jumps out?
Well, it's interesting. It is final demand trade services that really push things up, according to the Fed. And remember, those are derived from margins at wholesalers and retailers. Over a third of the January increase for final demand services, which were up by 0.3, a sixth consecutive increase, came from that category that included trade, automobile retailing, truck transportation. Those were some contributors to it. We did see a bit of a decline in fuels, though. Goods were up 0.6 in January. That's the fourth consecutive increase. And it's another month where now goods have moved up in price more than services, reversing what we had seen before.
Mike McKee, thank you. To extend the conversation, joining us now, Andrew Hollenhorst of Citi. Andrew, you've had in the books for a while that you expect the Federal Reserve will reduce interest rates this year. I believe you think it's going to happen now sometime later on in the spring, around May time. How does this CPI number of yesterday and PPI this morning help your case?
Yeah, this definitely still is all in the column of the Fed is not in a hurry to reduce interest rates. That's what we've heard from Chair Powell. That's what we saw at the January FOMC meeting and in congressional testimony. So they're going to need to see some more evidence that inflation is cooling. I think they will get some of that in the PCE reading. Now, you want to be careful here. We have CPI, we have PCE, we have year on year, we have 3 month. You can look at all these different metrics on inflation. When you dig down into the details, the fact that shelter inflation is slowing down, I think that is going to give Fed officials confidence that we're getting some slowing. In terms of what this PPI number means, I think part of the reason the market is reluctant to react is you really have to look at these detailed categories and how they're going to play into that PCE reading that I think is going to be softer than the CPI reading we saw yesterday.
Well, Andrew, let's try and stay on the details then. When you think about the sources of inflation, energy, labour, goods, services, what do you think the source of disinflation will be through the next year or so?
I think the single biggest factor that is causing me to be confident, and I think will cause Fed officials to be confident that inflation is slowing, is a slowdown in shelter prices. Again, even though we saw a stronger overall reading for CPI inflation, we saw shelter prices that were slower yesterday. And if you look at what was strong in the CPI reading, it was really things like motor vehicle insurance, used car prices. These are more volatile categories and categories that don't get, in some cases, as high a weight in the PCE reading. So I think we'll see some volatility in CPI, but that through line, as Chicago Fed President Goolsbee would say, is still lower in inflation.
What would you have to see, Andrew, to change your view that maybe this is something that's a bit stickier?
Yeah, so what would be concerning is if you saw just a lot of residual strength in wages and in services prices. Now, we still have somewhat elevated wage growth, but it looks to be cooling. We know the labor market has softened, maybe it's kind of stabilized more recently, but softened before stabilizing. That should all mean that we get a glide down in wages, we get a glide down in services price pressure. If we're wrong about that and you were to see wage growth that was actually picking up again, that's where I would get concerned. That's where I think Fed officials would get concerned.
And it's the reason why that was the number that people looked at in the jobs report, the payrolls report that we got last Friday, although it was explained away by the hours worked going down. I am curious about which aspects people are honing in on that are not necessarily inflationary. When you have fairly broad-based inflationary pressure, people had theorized that you would get this disinflation in services that was enough to offset a reinflation in goods. It doesn't seem like that's happening to the same degree that people previously expected. Why do you dismiss that?
Well, I think shelter services are on track. The non-shelter services, that is where we should be concerned. And again, it's this whole issue of wage pressure, labor markets, and does that bubble up into services prices? We saw that again in the January reading, this what we call residual seasonality, where people increase prices at the beginning of the year, and they increase prices by more at the beginning of the year, and we get these really strong January readings. So I'm really looking to see not just in the January inflation number, but what do we see in February? What do we see in March? I think those services prices are going to cool again in February and March. They were cooler in November and December. So if you put together, 5 out of 6 months that's cooler there, and you have wages that are slowing, that's a pretty good picture for the Fed. We have to watch these next couple reports.
Andrew, today's the big one, apparently. Reciprocal tariffs. We've had this conversation about inflation without talking much about trade. Now, Andrew, you've got as a baseline interest rate reductions for 2025. How do you think about tariffs and the potential feed through into higher prices? We've got 10% on China. We could have more still to come.
Yeah, so the details are what are really going to matter here, and we don't know the details. I do expect we're going to get some kind of broad-based tariff. That's been pretty core to the Trump administration messaging, to their economic policy. They need that both for incentives to produce in the U.S. as well as to raise revenue. The question is, are there any carve-outs to those tariffs? Are we including Canada and Mexico? That's almost 30% of trade if you include or exclude Canada and Mexico. So that makes a big difference. Also, are there carve-outs for certain products? That can make a big difference because some products you would expect those tariffs to be almost fully passed through into consumer prices. Most products you would expect those tariffs would not be fully passed through. So the inflationary effect will be less the more you get carve-outs and the more you focus on those products where you get less pass-through. If the inflationary impetus is not too great, then I think Fed officials can say it's a one-time price level increase. It's not an inflationary pressure issue. The challenge for the Fed is going to be if inflation is not otherwise slowing, can you say that? So I think you need inflation to be slowing down just by basic macroeconomic dynamics. Then you need these tariffs to not be too great an extent. Then you will get a limited Fed reaction.
Andrew, that sounds a lot like transitory. And that argument's not a good one these days, even if they think it's the right one. You saw back in the middle of September that inflation expectations bottomed, at least market perception of inflation expectations. Andrew, the Fed chair, as Lisa pointed out, Chairman Powell kind of pushed back at the idea that they contributed to higher inflation expectations with 100 basis points of rate reductions. Andrew, can I get your thoughts on that just to wrap up? Do you think they did contribute to higher inflation expectations?
I think it wasn't so much the Fed rate cuts. I think it's more the expectation of tariffs. We see that in the consumer surveys where people say they're worried that prices on durable goods are going to go up. So I would see that as more tariff related. And it's the short-term expectations, one-year expectations, not the long-term expectations that Fed officials would worry about more.
Andrew, appreciate it. Thank you, sir. Andrew Hollenhorst there of Citi. That's the Fed's problem, Bramo. I think you've nailed it. When you really think about the distinction here, the Federal Reserve might sit there and say, this is a one-off price increase to the price level and we can look through it. Consumers aren't doing the same thing right now. Maybe that changes, but at the moment they're not doing the same thing. And consumer expectations is something that spooked the Fed last time around. Does it spook them this time around?
At the same time that you're seeing companies actually successfully raise their prices, that's what we have to keep going back to. Not only are consumers maybe not looking past this, but companies are trying to get ahead of this and might even be jacking up prices in anticipation of those tariffs to get a bigger cash pile to gird against whatever might come down the pike. Unclear if this is going to be a real mirror image of what happened in 2017, 2018.
Brian Weinstein of Morgan Stanley joins us now to talk about the market impact in the bond market right now. Brian, yields are dropping. We're down 5 basis points on a 10-year, 457. We're down 4 at the front end, 431. I guess why is the first question. And the second question is, would you do the same thing?
Yeah, why? Who knows? I mean, these markets are choppy. They move around. Listen, I think what's happening, John, is we've done a really good job of pricing in a lot of this inflation risk, right? I mean, break-evens are higher, yields are higher. I think what the market is going to switch to is worrying about the growth side of this equation. So you can't raise prices and raise uncertainty and continue to raise growth expectations. And you know that I've been bearish on interest rates. I think eventually we'll get to 5.25. I don't think that time is now. I'd actually be a buyer of interest rates here. I think rates could fall a bit. I think we're overextended on growth. I think risk assets have done well, but they've kind of started to peter out. And so I think what the market is anticipating is that we're going to shift this conversation to the growth impact of all this uncertainty and the tariffs.
Brian, are we seeing that? in anything tangible, that there is a growth impact that's starting to feed its way into markets, but also the companies that everyone is looking at?
Listen, I think you've seen it in some earnings, right? You've certainly seen it on the lower end consumer. I think you see it a bit in the yield curve, right? I mean, listen, the long-term trend here is steeper. We can go a lot steeper given deficits and things like that, but we've stalled, right? So you don't see that fear. And I think taking the Fed out of the equation, right? The idea that we know they want to ease, they always want to ease, but they can't do it here, right? They definitely contributed to higher inflation expectations. They definitely eased at a time that was a bit inexplicable, and they're stuck a little bit as tariffs come in because it's not going to look good. So the Fed can't go. You see some weakness in some low-end consumer, and so I think you're at the very, very fringe. I don't think it's today. It's not in the next hour. This is coming up in the next couple of months. I think we shift into that growth fear. This is just the early edge of it.
A lot of people were saying you would see that in the initial jobless claims, and that really is going to be the data point, the high-frequency data point to watch. We just got it, at 213,000, below expectations, pretty much in line when it looked at the revisions of last week. We're not seeing it affect the labor market, and real wages are actually increasing to some degree. At what point do you need to see confirmation in some of this labor market metric in order to continue believing that the growth shock is going to become the preeminent concern that plays out in markets?
Right. Listen, I think you will see it eventually. I think companies are doing a better job of not overreacting. So I don't think you're going to, again, this is not a call for some type of massive, down trade. This is just saying, you could go off 5 or 10%, and jobless claims will trickle higher. I don't think you're going to see massive layoffs. So you'll see it in jobs, but I think you're going to see it more in earnings. I think you're going to see it more in consumer behavior. And so, yes, that will trickle through to jobs. But listen, jobless claims has been amazingly stable. We have a lot of dynamics going on, I think, in the labor market with immigration and things we don't truly understand how they're playing through. And so I'm not looking at every Thursday being like, today's the day. And again, I'm not a big risk off guy. I just think that this is the stage in which we've moved real rates really high. Growth expectations are high. Inflation expectations are high. I think listening to Andrew, I don't think they're easing in May, but I think the pieces are there to say we've pushed this as far as we can push it in terms of growth and inflation expectations and interest rates.
But how are they able to ease this year when there's so much policy uncertainty? I mean, today we're waiting on this potential reciprocal tariffs we're going to get from the White House. How is the Fed able to do anything until there's real clarity?
Well, you know my view. I don't think the Fed is in play. I don't think they can ease. Even if you start to get some weaker growth, again, we're not talking about really weak growth. We're not talking about, I don't think, a recession. So if inflation expectations are sticky, which they are, again, even if inflation comes down towards 2, I don't think anyone really expects it to go below 2. So we're talking about inflation of 2 to 3 or 2 to 4. So the Fed, I think, has a problem unless you get a real growth shock. I would say I think the Fed can ease this year. I would put a September, October, November kind of time frame on it, because I just think between now and then, unless I'm wrong and you do get a huge downside surprise, they're stuck trying to prove to people that they're fighting inflation. And that is going to take a little bit of time to prove. The growth side, even if we come down a bit from these valuations, I still think we're okay.
Brian, just to wrap it up, spent a lot of time on rates and what you would do in fixed income. I just want to finish on what you do with risk assets. Credit spreads, as you've noted, struggling to make new tights, equity struggling to make new highs. What signal do you take from that?
I think people are still going to gravitate towards quality and income, especially in fixed income. But on the equity side, and then therefore I think on the high yield side, I think some of these assets where cash flow is not as strong, where credit quality is not as good, I think you're going to get a correction both in the riskier part of the equity market and in the kind of high yield side of the fixed income market. So as someone who still thinks if we get to high yields in say 6 or 8 months when we're through this growth scare and get to tighter credit spreads, I don't think I'd play that now. I think I like duration a bit more. I still like quality, but I'm a little bit more bearish on credit spreads for the next couple of months.
Interesting, Brian. Appreciate the update. Thank you, sir. Brian Weinstein there of Morgan Stanley. As we look at the bond market, it's rallying. Yields are down across the curve. On a 10-year, we're down by 4 basis points. On a 2-year, we're down by 3. With an update on stories elsewhere, with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. A quick recap of the data from moments ago. U.S. wholesale prices picked up in January on higher food and energy costs. PPI for final demand rose 0.4% from a month earlier. That is higher than the median forecast of 0.3. Compared with a year ago, the figure increased 3.5%. That data comes after yesterday's hotter than expected CPI print. Elsewhere, Hamas said that it will free hostages on Saturday as scheduled. At least 3 Israelis held by the group are set to be released in the next round of phased exchange for hundreds of jailed Palestinians. Hamas had previously threatened an indefinite delay in the swap, citing Israeli truce violations. The leaders of Canada's provinces and territories have met with U.S. lawmakers in Washington to lobby against President Trump's proposed import taxes and tariffs. The premiers emphasized the importance of a good relationship between the two countries to keep prices low for America and urged the U.S. to reconsider its tariff plans. And that's your brief. John.
Danny, thank you. Appreciate it. Thanks for this morning. Up next on the program, we'll set you up for the day ahead. It's the big day. Reciprocal tariffs coming from Washington, D.C. We'll get you an update from the nation's capital in just a moment. So this is the setup going into the opening bell. Equity futures on the S&P positive by 1/10%. Likewise on the Nasdaq, outperformance on the Russell. Check out the bond market, a rally. Yields down across the curve. Now why? We just got hotter than expected PPI following hotter than expected CPI. Details matter here. Big thanks to the Bloomberg team just for flagging this one. The categories in the PPI that feed into the Fed's preferred inflation gauge were more favourable for the month of January. So we're trading on the details beneath the surface of PPI. A lot of nuance to this morning.
They're looking at things like declines in most healthcare items and airfares and tangible components that go into that core PCE metric that Jay Powell pulled out yesterday in the hearings and said was 2.6% as evidence that it still is on a progression of downward moves.
So that's the economic data. Then we've got to work with this one. Check this out. 1 p.m. Eastern Time. News conference on reciprocal tariffs today in the Oval Office. This coming from the President of the United States. Make America great again.
And he's supposed to be meeting with the Prime Minister of India, who potentially is going to be on that list for reciprocal tariffs. Trump earlier this morning, he said that they're coming today. Yesterday, he said maybe today, maybe tomorrow. The question is, what are the scope of these? Is there going to be a long timeline? And potentially, is the president willing to use this as a negotiating tool? And is there going to be enough concessions from these countries or the European Union, from the continent, in order to assuage his concerns?
We said it first thing this morning. This is the most fascinating time in financial markets worldwide since the pandemic. Let's get you some morning movers. Let's cross over to Manus Cranny. Morning, Manus.
Jonathan, that confidence carries through for Cisco. So confident are they? Even in the face of tariffs, they're raising the guidance up $1 billion to $56 billion for this year. AI is boom time. We're firmly on track to deliver over $1 billion of revenue in AI. The personification of a slowdown in Deere, down 4.5%. This company made $869 million. A year ago, it was $1.75 billion. North American sales will drop by 30%. Just think of a headwind if those 25% on steel and aluminium endure. AppLovin, wrap it up with this. Stock up 700% last year. They're helping that direct-to-consumer funnel and target their clients on TV. It's the app. If you're in direct-to-consumer, this is the advertising system you want.
Manus Cranny, thanks for the update. A few names to watch going into the opening bell and something new to watch later on in today's session at 1 p.m. Eastern Time. The President of the United States holding a news conference on tariffs. Then tomorrow, more economic data. We'll get retail sales. Plus, the Munich Security Conference begins before we get a long weekend stateside. Before we get to that long weekend, we've got a big news conference coming up a little bit later. Joining us now from the nation's capital, Tyler Kendall of Bloomberg. Tyler, what are you looking for from the President at 1 p.m. Eastern Time?
Well, John, one of the biggest questions is what the timeline for these reciprocal tariffs would be. As we've seen in the past, particularly with those steel tariffs that we've been discussing, he left kind of a long timeline, right? 4 weeks, essentially, for these negotiations to start to take effect before they go into place on March 12th. So how long will those negotiations be? And what sort of exemptions we could be expecting? There was preliminary reporting that maybe countries wouldn't necessarily be exempted, but that we're going to be watching some key industries, including autos and pharmaceuticals, and whether or not there will be any exceptions there. Of course, we had known that this was coming today before India's prime minister touches down at the White House. He is expected in the 4 4 p.m. hour, and we are still expecting a joint press conference between him and President Trump later on in the 5 p.m. Eastern hour. So big questions there, particularly if perhaps India can get ahead of this and make any concessions to President Trump, as we've already seen them starting to put out there that they are slashing their own tariffs in a bid to prevent against these incoming reciprocal tariffs.
Slashing their own tariffs, buying some more liquefied natural gas from the United States this morning. We're seeing a number of gifts really just seep through. Tyler, paint the scene of how this might actually happen. We're going to have tariffs potentially on India at 1, and then Modi comes in at 4. What is the president after?
Right. Well, we know that they're immediately going to go into this closed door bilateral between the two leaders. But as we've been reporting, they have been in negotiations ahead of this. We know that administration officials in Modi's administration have looked at upping LNG, also upping imports of defense weapons from the United States. Now, remember, Annmarie, as you know, this is likely making good on a campaign promise from President Trump that he wanted to impose universal tariffs. So while this might not be universal in the sense, there is this sense in Washington that reciprocal tariffs will essentially accomplish that goal to have a widespread tariffs to hold these nations, as President Trump says, accountable. But at the end of the day, we're going to have to see whether or not this is a negotiating tool or if this is going to accomplish that rebalancing trade priority that we have often heard President Trump speak of.
Tyler, thank you. Appreciate it as always. Thanks for this morning. Tyler Kendall. We'll give you that coverage a little bit later on Bloomberg TV at 1 p.m. Eastern time when we expect that news conference. Bramo, here's the deal for markets. Point 1, what are you looking for? How big are the tariffs and on who? Point 2, do you think they're going to stick or not?
At what point are they not just negative infinity in your calculus? And that, I think, is the key point that I took away from this morning.
Well said. That and a whole lot more, of course.
Yes,
3 hours of program.
lots of stuff.
Obviously. Tomorrow, the lineup looks like this. Jim Bianco of Bianco Research, Peter Chia of Academy Securities, Lindsay Piegza of Stifel, and Amanda Linen of BlackRock. From New York, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.